Hello and good morning, good afternoon, wherever you are. Welcome to our session this week with this in my hands-on seminar, Profitable Trading with TDW Trade Finder and Bookmap. And we will discuss and I will show you how to find high probability trading opportunities. So thank you for your participation, and I'm really happy. I'm a little bit, I have so-called stage fever. But anyway, I'm really happy to have you here in this virtual room. I regret that we can't meet in person. I hope one day it will it will happen to meet you all in person and to discuss and to trade and have some fun. But anyway, thank you again. So I'm really happy to have Bridge with me, Bridge as well. I missed you a long time and I'm really happy that you are here. Chris, mate, great to have you here again with me. Welcome. Christoph, welcome to the seminar as well. Ed, happy to have you around here. By the way, Ed, I hope all my emails will come through or you received everything I sent. Frank, great to have you here again. And Jay, yes, good to see you in the seminar. I'm happy to discuss with you everything here. Karen, I don't know you, but anyway, you are welcome as everyone. Levi, yes, Levi is from Israel, and it's really great to have you here in this live seminar, 4-day live seminar with us here. Myron, I would suppose it's Myron. Welcome to the seminar. Ramo, hey, great to have you in my seminar. And I promise you, you will learn some interesting views how to trade and how to, how to trade the market, how to see the market, as we discussed we are via email. Robert, welcome to the seminar. Srinivas or Srini, great to have you here in this in the seminar, in this room. Tom as well. Yulas, I'm not sure how to spell you, Yulas. So great to have you here, and Eve as well. So yes, Yulas, thank you. Eve, yes, thank you very much to be with us this week and with me this week. So I suppose you can hear me and I suppose you can see me on my video. Is this right? Can you type on Y in the chat? Just okay. Good. By the way, guys, in this seminar we will work on from my point of view, on the main goal to make every one of you here in the room. And there are still some missing participants, but I hope they will join us along the day and the next days, I'm sure. We will work on the self-confidence in trading. And I'm 100% confident and sure that I can make you robust and to finally make money in your traded market. We will talk about futures, we will talk about stocks as well. And I will, as you maybe you have seen in the documentation, I will talk a little bit about options, because options and the influence on the markets is extremely important. I will go through the intention of this goal for this seminar in the next minutes with you. And finally, will prove what I'm lecturing here with TradeFinder and Bookmap. This is like looking through a microscope and see what the market really discloses nearly every day. Not every day. It is not a 100 proved system, but you will see that nearly every day what the market is offering us. I don't know who joined right now. Let me see. Raymond, Myron, maybe I missed someone here. Argo, oh yeah, great, Argo, you are here. And Sebastian, good to have you here again with us in this seminar. Argo and Sebastian, welcome. And one word before we continue. So as you can see, we are from totally different countries here with different knowledge, with different languages. And I would like to ask you to respect all members in this seminar and help everyone, if you can, as you can, to rise to a level where we all gain more and more self-confidence in what we are doing in trading. This seminar is planned to be 4 days. My intention first was to do 2 days of theory and then 2 days live trading. I'm not sure whether we can make it in 2 days of theory. You see, you have seen you have hopefully the documentation in front of you, and you see the 120 pages. It's I don't know what will be the outcome. So I ask you kindly maybe to reserve a little bit more time in the evening in European time, and in the afternoon US time, to stay here in the room and to discuss all what I have prepared, and then let's see what happens and what time we need this week for the 4 day seminar. Most important is, my intention is not to preach. My intention is not to talk and to do a monologue here in this room. My intention is, and our intention should be, to have a vivid discussion in the room here. Not only in the chat, but with the audio. So I hope everyone has a microphone attached to his laptop, PC, whatever you might have, and then yes, please use your microphone. You are muted right now, but you can unmute you at any time you want to discuss, you want to throw in something which is important for our seminar, which is important to discussion, to clarify a lot of questions which might come up during the theory, because something of this this documents and this topics might be very new to you, and therefore please use the microphones. If you want, you can even put your video on so that we can talk virtually on Zoom here. That would be great if you can do that. So I will encourage you, discuss with us, discuss with me. I will try to answer every question if I can, of course. I think I'm quite confident that I can answer the most questions, but I'm not sure though. So we will see what happens. So microphones are open. In the recorded videos, yes, the videos will be recorded. The session will be recorded. All 4 days, I think. Yeah, all 4 days, especially today, tomorrow, and Wednesday and Thursday will be recorded. As I wrote, I don't have the time to cut and edit the recordings for every day. I will do that in the near future when I have a little bit more time. And therefore, when we discuss, so when Jay or Karen or Tom or someone is talking to us here, I can't prevent that the first name appears in the discussion and will appear on the recorded video as well. So please keep and respect the copyrights and keep the recordings with you. They are not intended to be distributed outside this seminar, of the seminar members and this, let me say, room. Another point is the power and internet interruptions. I hope everything will go well. So now we don't have any power interruptions, internet or hardware issues or whatever. If that happens, and that happened in the past one time, and that's my nightmare, if it happens, we have to find another day, maybe on weekends, some Saturday and Sunday, as a backup to discuss and to go through the material you have in front of you. So please keep in mind, if something happens, we have to find another day to accomplish and to finish the seminar and to get yes to provide where I can provide everything I want to show you and to discuss with you. If that happens, I'm sending you an email, and therefore please be sure that my emails from wtl@ttwtrader.com are not going into your spam folder of your email program, whatever you have. And one of the other nightmares is when I'm sending out material and then the email program bounces back, and then it's really hard to get in contact with you because I have only your first name and surname, of course, and the email. Good. Then the power interruptions and Okay, good, guys. That's the first. That's the first few minutes of this seminar, just to make some organizational, to play some organizational ideas I have with it, with you. So microphones are open. You can use your video or cam, whatever you have. That will be great. So we have another participant, and I can't see that here on maybe it's Robert, I'm not sure. So I can't see that here on Zoom because it goes goes from A to Z and Y, and it's not doesn't show who enters the room here. Okay, great. Anyway, again, guys, welcome to this seminar, and you will see we will have an exciting and highlighted week, or 4 days at least. Okay, first of all, as I mentioned, this presentation and video material is protected by international copyright laws. I ask you kindly, because this is a big effort, I put a big effort in this presentation, in the logic, in the structure of this seminar. Please don't distribute it outside, and please keep the privacy, as I mentioned before. So no part of this publication and video material may be reproduced, distributed, or transmitted in any form or by any means, including photocopying, recording, or other electronic or mechanical methods, without the prior written permission of the publisher. I kindly ask you to do so, and because it's really worthwhile, you will see and will you value the information at the end of the seminar, and as well we will discuss that as well. The seminar end is not it's not the end of everything. We are in the room, we will be in the room, and we can discuss everything in the Discord room. I'm talking about the Discord room as well. So then the really necessary risk disclaimer. Risk disclaimer here, as you know, trading is risky business, and it's not suitable for every investor. The highly leveraged nature of futures trading means that small market movements can have a great impact on your trading account, and this can work against you. If the market moves against you, may sustain a total loss greater than the amount you deposit into your account. You are responsible for all the risk and financial resources you use. You should not engage in trading unless you fully understand the nature of the transactions you are entering into and the extent of your exposure to loss. Trade only with risk capital, which means that you trade with money that, if lost, will not adversely impact your lifestyle and your ability to meet your financial obligations. Past performance is not necessarily indicative of future results. And if you do not fully understand this risk, you must seek independent advice from your financial advisor. Okay, that's important, but as well you have agreed to the T&Cs for this seminar. Let's start. Slightly jump in into the seminar. I would like to start with this slide, paradox of indicators. Because, as I mentioned several times, I would like, and that's my intention, that's my attitude, I would like to trade and not to guess. And as you see, indicators can have different meanings. Nothing against indicators, ladies and gentlemen, nothing against. We all need indicators on the chart. That's all good. But what I would like to make you a little bit more sensitive about the indicators is that, as described here on this chart, when Rob says, why should I buy gold here, then the answer might be it's hitting support and has room to run. Excuse me. And when Phil decides to sell gold at a certain price, then the answer might be it's resting on support and it's going to break through. So the paradox of indicators is that we are now 20 people, 20 individuals in the room here. And that means if we are relying on indicators, it doesn't matter what indicators we have, then that might lead to 20 different opinions, if not even more than 20 different opinions. What we see, what we experience, it depends on our trading experience, trading time, screening time, and so on and so on. There's a bunch of there's a bunch of there's a bunch of situations where we copycats will be eaten. There's a bunch of indication individual situation where you see an indicator and you see, let me say, yes, something else or anything else in this indicator. So your interpretation of this indicator might be totally different than my interpretation or our interpretation of the indicators. And that's the paradox of the indicators. As well, guys, I'm not saying that I'm not at all against indicators. We should and we have to have them. That's completely okay. But what I want to stress during these 2 days here with you is that I would want to show you that we should not guess. We should interpret something on the chart. We should have the same opinion, and that's really an art of trading. We will talk about liquidity very shortly, in a few minutes. And I think when I'm talking about it, to give you a picture, what I have in my mind is when we see liquidity on a chart, especially I'm talking about Bookmap here, then I think all 20 or all participants here, all members of the seminar will say, yes, there's a liquidity. And there is no room for interpretation because there is liquidity. Liquidity can be there for a long time, for a short time. It can be cancelled, of course. But we want and we will rely on facts. On facts, that means when we see liquidity on chart, then there is liquidity on chart, and there is no other interpretation. Let me say possible. So additionally to this, additionally with this paradox of indicators, I will show you my holistic market overview. My holistic market view, what I'm trying to show, and we will see that in the strategy section. So my idea for the seminar was, first of all, we have to set a foundation. Some of you have been a part of my prior seminar, which was really a long one, 5 days. I put together 300 pages of documentation and sheets and so on. And what my intention is to set a foundation here first today and maybe tomorrow. I'm not sure how we are progressing, because you have as well to digest all this knowledge of all this information I'm giving you today. And then we are going to build a strategy upon this foundation. And what I want to show you, that we should have a holistic market overview and holistic view on the markets we are trading. You let it be as it is. We will talk about later. If with our different opinions on the available indicators there would be no market, yes, of course. The question is now, we want, and that's one of my goals, to be more confident about what we see on the chart. We can discuss about an RSI, we can discuss about, Elliott waves, for example. Is this a wave 3 or is this not a wave 3? Is this an ABC correction or not? We can discuss that day in, day out. But what we want, and that's the goal of the seminar, I'm coming here to this, what I want to achieve this week with you is, I would like to training your amygdala, I'm not sure if I pronounce it right, amygdala, to trust you. And that might be a little bit off, or that might be, I'm not sure really. If you have something to say, use your microphones. The microphones are open. So again, I don't want to talk all the time here because it's really demanding, but if you have to say something, use your microphones. Be so free, don't be shy. That might be a little bit strange when I'm saying I want to train your amygdala or your brain to trust you. As well, you see the where I've got this information from is the Chimp paradoxon. Oh, I see there's a typo. By Professor Steve Peters. So I'm holding. Where is the camera here? So the chimp paradoxon. I would like to motivate you to read this book, The Chimp Paradox. What is it? Very, very briefly, very, very short to get you on board. Let's imagine we are sitting around the fire 1 million years ago, and we even maybe don't know what this yellow hot stuff is where we are gathering around, and we are simply putting our hands to feel and to understand what we see here, what's this event, what's this stuff here. Then we will burn our fingers first, and then we will get back with the hand and maybe look what happens with my hand, and maybe we will do that 2 times. But I doubt that we will do that 3 or more times, because if if we want to protect and stay alive, then our brain is the most fascinating organ in this universe we are living in. It's really amazing. And what I'm saying is, we have a fear center. And that's the fear center of every one of us. There is no exception. Of every human being is the amygdala. And that means when you burn your fingers or your hand 2 times, I doubt that you will do that 3 or 4 times, because this part of our brain tries to protect us. That's our life surviving mechanism in our brain, which tries to protect us, to make mistakes, to put our lives on concern and so on. And that's the amygdala. But besides all the normal natural behaviors we experience as individuals every single day, we have the same behavior in trading. We have the absolutely same behavior in trading. So first of all, when I started trading, I was with Larry Pesavento and Bryce Gilmore. When I started, they have been on his harmonical patterns. They have been on harmonical patterns. And then I was totally excited about what I saw. That was 2000 and later when the crash started. And it's normal. Then you start trading. You learn volume profile, market profile, Elliott waves, gun times, whatever. Is that you start, and maybe it works even. It starts to work, and then you are excited because you are, maybe your dream come true or whatever the motivation you had. But by the time this declines, so you start to make errors, to make failures. You see your account deteriorating by the time, and that's where your amygdala, your chimp inside you starts to scream, no, don't do that, no, execute, no, don't do that. It's simply a protection mechanism. It's a protection mechanism within us. And why is that? Why is that protection mechanism here? Why don't you trust yourself to execute a trade? I mean, there are for sure several reasons why we can't. Oh, you see, look here. I missed this trade by 2 points or 2 ticks or whatever. Oh, I missed it, and then some relaxation is coming into your body, and oh God, I missed it. Yes, it's not bad. I'm sad, but I missed it anyway. This is the contradiction between the system within you, the chimp paradox, and the chimpanzee in you is saying, don't touch it. It's dangerous. Your account it goes against zero. You lost everything. Don't do it. That's the sole purpose of the amygdala, of the fear center, to prevent you to lose your life. And the same, the same behavior, we see that in trading. And why is that? Why is that in trading? That's because we rely on different views. We rely on interpretation. We rely on maybe other gurus or whatever at the end, and it confuses us more than it makes us self-confident. In this seminar, in this very short seminar, I must say 4 days is nothing, I will show you that you can understand what the market is doing. And when you don't understand what the market is doing or what the market is showing you, doesn't matter, we will talk about futures, we will talk about stocks, then keep your hands off the market. And what is the learning effect, or what will be the learning effect? When you understand the holistic market view, I will show you in the seminar, then you will gain self-confidence in your execution. And by the way, the most important part of our being as a human being, of us as individuals, is when you get step by step, when you understand step by step what the market is doing, then you will get self-confidence, and the effect of your amygdala or your brain on this fear center is that a chimp will step back and let you do what you want to do. So trading is not a rocket science. You will see, I'm sure you will understand every point we are discussing within this 4 days here. I'm sure that's really nothing we need to have a degree in as mathematics or rocket science or medicine or whatever. No. But we are struggling because most of us struggling because we are not self-confident enough, and our chimp is always firing. Do not. And when you prove that you can trade, you will see the effect that the chimp will slow down. It will become more and more quiet, and then you can execute because the chimp starts to trust you. That's highly interesting. Again, guys, if you have the time, and So here's the camera here. If you have the time, go through this book from Professor Steve Peters, The Chimp Paradox. And you will, it is enlightened. So I just want to recommend it, to read that, because it's important. And that, by the way, why have this Mr. Steenbarger, and who's the other guy? I forgot. Steenbarger is more prominent, and there's other trading psychologists. They have really a good time right now, because a lot of traders need their help. Not because we are thinking, oh yeah, I have a problem with trading because my friend is telling me he is making everyday profits and I do not. What's wrong with me? That's totally nonsense. That's totally nonsense, ladies and gentlemen. We are good. We are wonderful individuals. So don't fall in on a trick or spam or whatever to saying you are not able to trade. It's not the ability to trade. It's simply that you should understand and see what the market is doing, and then you can become profitable. And the more profitable, even if it's a small steps, the chimp will understand that you are in full control, of trading, and then the chimp will step back and let you do your business. That's the goal. I will show you some why I think this approach is the best one. We will discuss this during the next days. So understanding a holistic market view, that what I recommend and what I will try to show you. Achieving the goals based on TTW, TradeFinder and Bookmap. That's simply because I think TradeFinder and Bookmap are genius. Genius, not pair but couple in this case. Because we can see events in the market where other simply just guess and can't even see. Even my colleagues from Bookmap do see that. And executing with an optimal risk-reward ratio. That's my goal as well. So I'm totally sure, guys, you can prove me and you will see that. I'm totally sure that you can execute with an optimal risk-reward ratio. And that in return will silence your chimp in you. So that this is a loop. The better you execute, even if you are going small steps with micros, for example, the better you execute, the silent your chimp will become. And that's the goal of the seminar. I'm looking forward to discuss everything with you here during the next days. I hope that we have some guys more. Alexander, hi, great to have you here. Okay, I lost it. I lost Alexander's iPhone. Okay, anyway, welcome to this seminar, guys. To those of you who joined the seminar right now. That's the goal, and maybe that is really something different. And tell you, okay, we are talking about market profile, and we will have here value at high and value at low, and maybe that line is other line. No, we are not. We try to make you a strong and confident trader. That's my goal this 4 days. I could lecture 2 weeks about this quite interesting dependence between our behavior, our brain, and trading as well. Any questions so far? Use your microphones. I think they are all open. If you have microphones on your laptop, if you have microphones on your PC. Nothing? Okay.
Looking forward to it. I have no questions so far.
Yeah.
Walter Schlini. Can you write the book name? Steve Peters.
Yeah, it's here. Just a moment. I put it in the chat here.
Thank you.
Oh no, better. Let me find it on Amazon.
That would be even better. Yeah, the
Yeah,
link.
yeah,
Please.
the link is better. I have a little different paperback here. Why can't I find it? Oh, it's a new one, The Hidden Chimp. Maybe this one as well, and then
Yeah, Walter. The new one is red color box.
yeah, it is.
Is that the same?
I'm not sure. So just to see that there must be an. I tried the ISBN. I don't know whether that helps. I'm a little bit astonished. I didn't know that this is really maybe an. It's quite an actual. Let me find this. So there's a excuse me, ISBN number, and I think it's you can find it by them. Okay, guys, it's the Chimp Paradox by Professor Steve Peters. A wonderful book. A wonderful book. It's not only about trading, but also as well about our whole life. It's nothing what we are talking just in trading, but it's the same behavior, simply the same behavior. Okay, guys, if you have questions again, please cut in and ask or discuss with me or with us here. So this shouldn't be a one-way monologue here by myself, but it should be a discussion with you because it's quite important. It's absolutely important for me. That's my goal, to give you the best I can do here, and then even to coach you then in the Discord room if possible. Okay, good. Then let's go here to the syllabus. I don't want to go through all this points here, but you see what we are facing in what's in front of us. We will start with the market basics because some of you here, I'm sure, you know what the market basics are, and but anyway, this will be the foundation, and I cut what I could cut out of my presentation, form of presentation, I mean, to pick only the highlights, and I will show you that based on TradeFinder, because I think TradeFinder is an excellent tool. You have just to understand how to use it, and you will see how genius it is. Let me see, a little bit exaggerated, but it's really helpful. So we will go through the auction until up to the volatility correlations. I will talk a little bit about options. I'm not an option expert right now. I will do more in options next year. But just to give you an idea what impact options on in our daily business has. and have, and that's important. But then my idea is, after today, I'm not sure whether we can do that completely today. If not, it doesn't matter. We can easily start tomorrow and continue with market basics, then go to the strategies. We have the Wednesday, we can continue with the strategies. What I want to show you is the relation, what I'm talking about, to the actual market. The actual settings, what I'm using in TradeFinder and so on, just to get everything straight, to connect every of these points. So look at the market basics as puzzle pieces, and as well as the strategies. These are all small puzzle pieces. And as I mentioned, I would like to make you, or to raise you and our trading probability greater than 50%. It would be great if we can reach 60%. That means 6 out of 10 trades are successful. Even if we can, the maximum, I think the maximum is 7. The maximum is 7, because there is no holy grail, or there are no 100% strategies or whatever out there, but we can connect everything, all these pieces together, put it into a picture where we see what the market is doing, and then we can and we will be better than 50%, and we should be better than 50%. We will talk even about 30%. That's as good as well when the risk-reward ratio is given, so a good risk-reward ratio. Strategies, we will talk about sweep, hidden order, icebergs, dynamic iceberg development, DID. We did by the way, the TTW, my team here, Trading to Win team, is doing an intensive forward and back testing and forward testing. That's not simply selling or offering an indicator like TradeFinder. No, the main purpose was to find a way in the market, to understand the market, and maybe to prove that on back testing and forward testing based on based on MBO data, if this idea or this strategy works or not. So guys, again, microphones are open. Let's talk about every single piece here, and let's discuss it controversially. It's not a love event. Although I love you all, but that's not a love it. So we need to discuss, to understand what we are doing here, and then it will help you to become a sustainable trader. Price dynamics plot, that's a great invention for futures. Daily institutional levels, I will talk very briefly about them, because they are, that's really obvious what they are. Business done pattern, I added it to this presentation. Cheat sheet features and for futures and stocks, and there's an addendum. I added market volume pro, but we don't have the time to talk about every single step piece of this. Documentation is available as PDF. Every one of you should have the newest PDF. By the way, the version of the PDF is on the front page. 11.14.2021 is the latest. If you find typos or something strange here in this presentation, or maybe a term has not the right meaning, please inform me. I will change that, and we'll resend the PDF, or the updated PDF then. You will get the recordings on vimeo.com with a protected access. Please respect copyright, and configuration files are publicly available on tradefinder.info/. Okay, settings. Good. So far, the introduction, the first 45 minutes, and I think what I wanted to show you, to tell you, is I have a really hard target, and I'm measuring myself based on the target. Okay, good. Any questions so far with this intro? Before we start before we start to dive into the basics? Okay. I don't see anything here. Do we need rhythmic future data or is the XVCME future data fine? We need rhythmic data to see all. Yeah. We can, to see icebergs and sweeps, we need market by order data, and unfortunately that's only rhythmic. And what is Sierra? What is the name of Sierra data feed? Not Cedro. I think rhythmic is the only one, and then the second one is Denali. Oh yeah, thank you, Denali. That's it. Okay, guys. For those of you, some of you will have been a part of my first seminar, which was really intense, about all this theoretical stuff around Bookmap and how to read Bookmap and what to see in Bookmap and so on. But what I want to do now, and I see that every day in the room, I see that every day with my Bookmap colleagues, and I see that based on the questions I'm receiving here, is the difference between liquidity and volume. That seems to be, yeah, let me say, not unknown, but it is really a little bit more, must need a little bit more explanation for everyone who wants to understand the auction. By the way, there's a group in, I think in the US, who are offering pit auction. How to say pit auction? This is a group who is dealing with the pit auctions as a leisure, yes, as a group where you can join and have fun with the pit auctions. That means really live auctions as they have been, I don't know, 10, 20, 30 years ago. So the main questions I would like to stress with you before we continue here is why do prices fall and why do prices rise? Before we can buy or sell anything, there must be an offer or a good of desire we want to buy. That's logical. If we want to buy fruits or vegetables or TVs or PCs, there must be an offer. We need to go somewhere to buy this goods, whatever it is. And on the other side, there must be people who are willing to sell something to us, or otherwise who are willing to buy something from us. This is a pure economical teaching, nothing really special. So that means in trading, we need a counterpart who is willing to provide something we can buy or we can sell to. We call this liquidity. So the goods we are buying in trading is liquidity, and there must be someone who is providing liquidity. So liquidity must be in the book. The liquidity must be in the book for every single instrument we are trading. So it doesn't matter futures or stocks, we need liquidity. Liquidity must be available in order to trade. If there is no liquidity, no one of us will trade or consume anything. That's simply impossible. Today, in today's markets, we trade. We take liquidity for granted. So when we go and trade, for example, ES future or CL future or gold or a stock, then we see the liquidity and it's there. We can buy a stock. We can sell a stock. We can buy an ES future contract, and we can sell an ES future contract. So that's for granted. We see that it's there, definitely. But it is not granted. Consider the current supply shortages over the world. For example, go look back in the last weeks. You can't buy an what was it, PlayStation 5, or you can't buy an NVIDIA high-end graphic cards, or you can't buy. We have a shortage of cars, or yes. Yes, car, great. Yes, that's what here in Germany especially, the cars are production is delayed or came to a stop here. The microchips, we are missing microchips. The shortages are great. So when we are talking about liquidity in trading, it seems so natural that this is there, but it's not. We need a liquidity provider. We need a liquidity provider in every market. We will talk soon about liquidity and their importance and significance in trading. It doesn't matter what you trade, by the way. Again, liquidity is far more important than icebergs, and we will talk about that. The second point, or what I want to say here, is that when you intend to trade, most probably you will not be the first. That means when you intend to buy on the daily market, wherever you are, vegetable or fruits, you must stay in a queue to do so. And that's the same in trading. So you will be a part of many, many others which are waiting in the queue to get a trade or to be filled. Either you are buying or you are selling. So that means you must wait until a so-called matching engine will match you, an arbitrator will match your order with someone who is willing to sell to you, or someone who is willing to buy to you from you. That's called the auction mechanism. And however, it seems that is not a part of our trading because we are focused on indicators and other, let me say, magic stuff. But keep in mind that everything you are doing on any exchange worldwide must come to the exchange and must be, it goes to a queue. It is a part of a queue, and then by the time it depends on how you place your order, market or limit, it will be executed, or you will find a counterpart. Let me say it's an individual. You have to find a counterpart who is willing to sell something to you or to buy something from you. What I'm criticizing, and guys, as well as I mentioned, microphones are open. What I'm criticizing in all the rooms I'm around here, especially in Bookmap, is that no one takes the dome, the order book, the depth of market as a serious source of information. It's really a serious source of information. It is important for high liquid instruments like, yes, it's not liquid anymore, but for example, treasuries. And it's hard to read for thin liquid instruments like NQ or CL or gold, and sometimes even, yes, when the volatility is high. What I wanted to say, I consider that as a mistake. Therefore, in this seminar, I will draw your attention the next days to the liquidity and volume model. And the liquidity and volume model, liquidity tracker, is the most important part, the most precious part of TradeFinder. And the liquidity model and volume model will guide us throughout our trading day. You will see that when we'll talk about hidden liquidities, relative hidden liquidity, and absolute hidden liquidity. It gives you such an, valuable and practical insight what the market is doing. We will talk about in a few minutes. So what I have here is simple an Excel file, just part of my other seminars. I would like very briefly to ask you, and that's your part now. I'm taking a short break here. Why do prices rise and why do prices fall? Let's discuss this. Just to be sure, we don't need to stay around here for the next hours and discuss this, but I wanted to
market orders.
Sorry?
Market orders?
Yes, and let's see. Let's say I'm just erasing this one. Let's say that's the order book. That's the dome, depth of market. The prices are here to the left from my side here, 150, 60, 70. This is the market bid and market ask. So what is needed to raise the price from 160 to 170? Chiara, hi. Can you display your screen? Do you see my screen?
No, I thought you were referring to the handout.
Oh. Excuse me. I'm was sure that I'm just displaying. Just give me a second. Just give me a second. I have to understand why you don't see my Excel screen. My Excel.
You have to choose your screen which you want to display, Walter.
Yeah, it is. It is. Give me a second. What the heck? Screen share. Why? Do you see my SPY?
You see your book map screen
Okay,
now.
okay. Can you see now the Excel file?
Yes. Yes.
Okay, something went wrong here, so I'm not sure what. If something is not working for you, you don't see my screen, you miss my voice, your video, whatever, please interrupt me immediately. Just a moment, please. So you see my presentation, brief introduction into an auction, and as well the Excel sheet. Is this right?
Yep.
Okay.
Just the Excel sheet.
Sorry?
Just the Excel sheet.
Okay, good. Okay, good. The Excel sheet right now is here on my screen, and you see this, let me see, this order book, the depth of market, where I want to restart here just to, the question is, why do prices rise and why do prices fall? So that's the question. So you see on the left side 160, that's the price, then 170 and so on. This is the price ladder here. You see this green is bid and this limit ask here is red, and on the ask we have 50. So my question was, and I hope everyone can be a part, just a moment here, be a part of the discussion. Everyone can be a part of this discussion. It's okay. I just have to manage my screens here. Excuse me. Good. The question is why and what do we need? What do we need to raise the price from 160 to 170?
You pick up that 50 offer.
Okay. So that means we need 50, and by this 50 we see that this 50, let me say these 50 guys or these 50 individuals here are buying 50 contracts from the ask. We are calling this the resting liquidity. That's what we are meaning when we are talking about liquidity. 50 guys, or let me say one guy maybe, is providing 50 contracts, 50 kilogram of apples. I'm not sure what US measures, but I'm using European measures, 50 kilogram of apples here, or 50 piece of apples. And there's some excuse me, there's one guy who wants to buy 50 apples, and then he got the 50 apples here. So this is the limit liquidity. And when he buys everything from ask, and the next one comes in, what happens then?
Price moves up.
Yes. Let me just, doesn't matter what numbers we have here, just to make sure what we are talking about. That means 50 apples have been bought at 160. The next one, because the storage is empty, the next who comes in will raise the price to 170 in this case, and then this procedure repeats. We need 19 again to buy everything from this guy, and then we are lifting the price by buying everything from ask. So just I'm doing a little, making a little pause here, a little break, just to get every one of you on board. We have liquidity and we have market volume here. Is that clear so far?
Yes.
Okay. Alexander, Argo, Brigitte, Chris, Christoph, Ed, Frank, Tanner, Jay, Karen, Kiara, Lazar, Levi, yes, Levi, Myron, Phil, Raimo, Robert, Srini, Tom, Yulas, and Alexander. Okay, now that's the principle. I mean, that's really static here, but it doesn't matter. That's the principle. And you will see that this 50 is... no, I have to fill this column here. Oh, no, that's bad. Why? It's not working. So let me make this green. You will see what I'm talking, because this is green because they are buying 50 and the next one lifts the offer. Going back,
yeah. Someone stepped in and said, okay, I want to live very healthy and I want to buy 70 on whatever price, and it's already gone.
Yeah. So just to make the opposite side, given there's no one who is willing to buy additional 19 at 170. Okay? Then what makes the prices fall? Why do prices fall?
Because someone is willing to take the lower price.
Yeah, but what happens mechanically? Think about an auction. What happens in the book? Or what happens in the market? We have understood why market.
Okay, then X number of contracts are traded at 160.
Yeah. How many exactly?
Just 50. We need more than 50.
Yeah, exactly. Because that's a really a theoretical discussion here, but just to give you an idea how this order book and DOM works and how an auction works. It's the same. It's a very simple auction. The very first seminar I did, I don't know, 4 years ago, we did an auction. So I was the auctioneer, and then the members or participants of the seminar have been the members in the pit, and it was totally funny to watch what happens when you are part of really a pit auction. So given we understood someone must buy from ask 50 and then lift the price, the next one lifts the price to 170, and in return, in reverse, if we want to, why the prices are fall is, as I don't know who was it. 50 must be sold to this buyers here, to this bidders here on the limit side, and if this 50 is sold, then the same action happens to the downside. So what numbers do we need here? So the next one who is selling makes the prices coming down from 160 to 150. What do we need at 150? How many contracts do we need at 150 to make the price fall?
69.
Yeah. Sorry. 7%. Yeah. What do we need to make the price coming back from 150 to 140? How many?
20.
Sorry?
20?
Yeah. You see, in this case, the price goes back here. To be very precise, when we hit this, that means we need here. So that's the book. So we sold 70 into 150 and we sold 20 here. That means we have to... It doesn't matter, the numbers are not important, just to show you the mechanism very short and what we are talking about. And that happens in extremely fast time, in milliseconds. That's really sometimes hard to watch. The only exception are treasuries, from my experience, where you can sit there and seeing what really happens in the book. But the prices rise. Let me just draw this red here. The prices rise because there are willing buyers to buy from ask, and we are talking about lifting the offer, and the prices fall because there are a lot of people who are hitting the bid, who are hitting into the bid. So now we are trading came down from 70, 60 into 130, 140 here, 130, excuse me. That's the actual traded price. So the market trades in between 130 and 40 here. That's the BBO, so-called best bid offer here, between those both levels here. When we are talking about this mechanism, about liquidity, and liquidity is, by liquidity I mean that's the resting liquidity on the ask and the resting liquidity on bid. We will talk about a little bit later again, and I will stress the liquidity because you will see, maybe even today we will see whether that happens, how the big players are playing with the liquidity, placing liquidity there, canceling liquidity, adding liquidity, and how TradeFinder will show you what's really happened in this market. That's quite interesting to watch. This in between the bid and the ask, this is the market volume. These are so-called aggressors. I'm stressing that because we need this as a common the smallest common denominator. Excuse me, I was watching for this word. This is the smallest, or the smallest common denominator here. We must know what liquidity is, and we must know what market volume is. These are differences. The guys are simply waiting for to be hit or to buy or to sell. It doesn't matter. And these guys, the aggressors, are coming in because they can't wait. They can't wait until the price comes to 130 or 170 or whatever. These are the aggressors. Now, one additional word why the prices comes down or falls is because there is no bid support. The main cause why the prices fall is there are no bids. If the prices deteriorates or we have a crash in the market, then you won't find enough buyers who are willing to stem against this drawdown in this case. That's the reason why prices fall. If we find support here, for example, he is selling, he sells 30 then you will see a refreshing maybe here to 40. Then he needs 10 more. Then you will see a refreshing to 60. Then he needs, yes, again, 20 more, and so on. That's really standardized. That's a standardized mechanism. It's valid for every single exchange and for every single instrument, for every single good or whatever. If you are buying kettles or flowers or futures or whatever, it's everything everywhere the same stuff. So that means at 130 we see support. At 130 we see support. Otherwise, we will see a further deterioration of the price, going down, up and down. And very, very briefly, very fast, I want to introduce you to the liquidity and the volume model. Once you understand that, it will help you in your daily trading every single day, because you understand and you have, now I hope you have a visual in your head between the bid and ask and the market volume. So, excuse me?
Walter, if like say 60 hit the bid market and 40 lift the offer at the same time, what happens then to the price?
60 has, yeah. That means
At the same time?
yeah. The same. What do you mean by the same time?
Yeah, in the very millisecond.
Yeah. They are supporting there. You see the same. You see the same behavior when here someone hits the 20. Let me say 20, and then you will see a refresh of the book, and then suddenly you see 40. So they need to find more buyers. Let me say they see another 20 is 40, and you have refresh here of 60 or 70, whatever, and you see this flickering, and the price is going nowhere because they are simply adding to a certain level, resisting at a certain level, and they are supporting at a certain level. But when there is no bid, that's the rule of every market. When you don't find a bidder, the market falls. It doesn't matter where. We have some auction houses. If you are going to an auction house to buy an art picture, whatever, you will have the same. You will have the same behavior. The auction starts with $1,000, and if there is no bid, the prices goes down to 800, and then suddenly someone starts with 800, 810, 810, 820, and then the price goes up. It's the absolute same mechanism. But we must be clear that this is the same mechanism we see in every single market, every day. Why I'm stressing that? Because first of all, the DOM is not a common tool, although it is free. It costs. It comes without any costs. But it gives.
Well, you have to pay. I think you have to pay to use the water dome within some brokerage company.
No. The dome is free. The dome is free for yeah. If you are thinking about Jigsaw Trader, then they're trading based on the dome. But the dome is free in Bookmap. The dome is free as well in I think in Sierra, in any other chart. The dome is there. Simply it's there. So that's what we should keep in mind, because it's so really precious information we can get of that. If we can't follow that, because we are talking about thin instrument like NQ, for example. I will show you that on live chart. Then no, let's do that immediately now. Just let's do this discussion right now, because it's important. This is the actual market. And therefore, and what I'm trying to tell people is, put the dome on your chart. Look around in different trading rooms. You will nothing sees. I don't believe that you will see something like that, because in this market it's possible to see something what we are talking about. We have the bid, we have the ask here, we have the aggressive volume, we have the I learned that from Jigsaw Trader. We have the quotes delta. The quotes delta, you see how they are adding and subtracting on, I'm measuring only 5 levels here. You see the greens here, these are the buyers from the ask, and you see the reds, these are the sellers into the bids. Please interrupt me if I'm too fast, please intervene if you want to know something, if you want to discuss, please do so. So, therefore we decide or distinguish between liquidity and market volume. That's the most, I know that some of you don't give anything about that because it's maybe not usual, but let me just come back to this one. I insisted when I was trading that I want to know the liquidity, excuse me, Chris, I'm insisting to know what liquidity is and know what market volume is. Because to see what is really happening in the market, ladies and gentlemen, what is really happening in the market. On one point, it gives you the information, okay, the ES E-mini trades at the moment for the first 16 level with 170 contracts in average. That means the first 16 levels from the best bid offer here, where this green or red line is, the first in 16 levels, you can extend it to 20 if you want, or to 10, whatever you want. Excuse me. You will see the average volume of the market. Now let's compare it to the NQ. The same picture. The only difference is I don't have the quotes delta because it's extremely fast, but it doesn't matter. Let's extend it for the NQ, and you see the difference, how thin this market is. Average liquidity 7, 10, based on the first 10 levels. If you see the BBO, the first 10 levels, the market volume is 500. It's the beginning of the session. No, it's not. We are in the main session here. 600. Which is not bad, which is really not bad. But you see the average liquidity, there's nothing. So therefore, that makes the speed. That makes the speed of this market here. Let's have a look at, let me see if Tesla is as well extreme thin. Tesla is as well extreme thin. You see average liquidity of the first 1,000 levels. I mean, the tick in Tesla is 1 cent. That means I'm measuring $10 is 65, 63. Market volume currently is not bad. It's 28,000 at the moment. Let me have another look. Maybe I have here as well the ZB. So the average liquidity is 500. And the
Walter, could you?
Excuse me, in the market volume is 800. So again,
Sorry, could you measure liquidity with like the spread so that if there's a, could you say like if there's less liquidity, the spread will be? Is that a valid statement?
No, it's not. We are not measuring the spread here. We are just giving the information how liquid the market is, because we need this information to set up the trade finder correctly, or to find the best settings for an individual instrument. Because I will refer to that a little bit back. We want to find, in trading, that's what I'm talking about. We want to find these swing highs and swing lows. We want to find and spot swing highs and swing lows. Therefore, we need a liquidity, but we are not measuring the spread. It's not. No, we don't do that. We simply measure the average liquidity of the instrument, and by that, coming to ES, back to the ES, we see. By that we see the how volatile the market is, the volatility of the market. Because when the volatility is high, you will notice that the average liquidity drops very dramatically. So even here, this average liquidity of ES is nothing, 160. That means we can derive out of this that the market is that the participation in the market is not high. I'm wondering if we maybe see even 1 million traded today. Then we can know And we will learn that this is a direct measure of the market volatility. When the market volatility is high, the liquidity drops, and vice versa. When the market source of the S, we saw even 300, 350 here. That means there's a confidence in the market. The market is strong. The market is confident. And this is simply, excuse me, this is simply a small measure. This is simply a small measure about the market. How to judge the market at the very moment when we are in and we see what the market is doing. It doesn't help us at the moment to understand whether we should buy or we should sell, but we have a good understanding of the market liquidity based on the depth of market, based on that what we see in the book here. And when you are missing this information, it's really hard to understand what is liquidity, what is market volume. Although these are two different meanings, and it will give you another. Let me just take this one here. I think maybe trading would be possible with seeing this live view of the liquidity, because if the market if the market volume is strong on ask, it's a little bit too fast. It's a little bit too fast now. If the market volume is strong on ask, what happens?
Prices will drop, I guess.
No. Okay. I can just make. Do you see my screen? I will put on this. So you should see my Excel spreadsheet on your screens, right?
Yes.
And the live view as well.
Yes.
Okay. It's not the best example, but we'll come in a few minutes. You see the green aggressive volume here, 50 and 30. That means that's the market volume, and this 30 and 50 refer to the ask here on the market volume, and the bid.
So we should go up.
Just not to
No, it
confuse.
depends on the it depends on the liquidity. If you have we have 176. So this in this situation will go up.
Yeah. I'm just a little bit confused because of the ask bid here. I'm not sure if we have another bug here, but you are right. If this ask if this green gauge here, or this bar, if is stronger than longer, and then the price will go up here. Now the price is going down, I suppose, here because they are hitting the bid here. They are hitting the bid. 633 into 190. It's a little bit not the best example, but I just wanted to show you that this has a direct impact on the price. So you see bid, they are hitting the bid, here. They are just refusing, price comes to a stop here. And it's not usable. You can't trade based on that because you can't, the aggressors come in and we can't predict when the aggressors are entering the market. But at the moment here, very nice to see the market should go up, or the price should go up here. They are buying everything from ask. They're buying everything from ask here. They're buying everything from ask. I suppose, the market's climbing a little bit here. So that's what you see here, just graphically displayed here on the live view. We will come back in the next session or during today. Question to the brief introduction to an auction.
Walter, we might cover the detail, but have you noticed the difference between those two is quite high? One is in 1,000, another is in like hundreds. That 1,000 should consume a lot of.
You mean you are talking about these numbers here?
Yeah. Now see, now you can it's in 800. Even the ask is like 400, but available over there is 175. Is that normal?
Yes,
That way?
yes.
Because that should consume a lot of those asks with that thing, right? It should consume a
Yeah, the market volume at 700 whatever 50 or something of 170, it shows that there is simply, I would say there's a movement in the market. It means the market trends. If you see 1,000, if we see 2,000, now we are a little bit too late now, 700, 1,000, 105, 2,000, let's say 2,000, then you will see this, it has a direct impact on the market speed. That means the price, let's example, you see 2,000 here, and you will see that the market goes up very, very fast because 2,000 aggressors, 2,000 participants, 2,000 guys like you and me, entered the market and they want to trade. Let's say they want to trade up into this liquidity here or into this VWAP or into this POC. Then you will see 2,000 very strong power in the market to move the price to a certain level. And sometimes when the market comes down, and then we will talk about volume spikes and sweeps, then when the market relaxes or comes down or calms down in this case, then you might even see maybe 100, 200, 300. And what you will notice then is that the market goes simply sideways. If there are not enough power in the market, aggressors, like here it's not the best one, but like here, so we have 500 and there are on every side, that means on bid and on ask 180 contracts sitting. This 180 contracts must be traded like here. So we have to find 50, we have to find 30, 70 in this case, we have to find 30, and so on, 60 and so on, 40. That's the same principle. But when you see this picture, now you see it 1,000 here, and we have on every side on the resting limit side 170. That means the market is there's some power, there's some energy in the market. They want to trade at those levels. We can't say the market is going up or the market is going down, but we see that there's there's a movement. The market moves. They are fighting right now with this level 83 or whatever it is here, and it's not sure where the market is heading to. But we see there is certainly a fight and something which will move the market. In other words, if you see 2,000, the market will jump up or down, and if you see let me say 200 here, you will notice that the market is going sideways. So nothing happens for minutes. Nothing happens. The practical question now for the trading is, if we see 200 here, for example, and the average liquidity is as well 200, does it make sense to trade then? Because the market is in choppy state, and that makes the market, it makes the market to take a break here. We can't immediately say the market is going up or down based on these numbers, but it gives us an idea how strong the market right now is. It's coming to a sleep here. Maybe we can predict the liquidity in the market. You see what happens here. We can predict that. But we can't predict the aggressors, when they are coming in, when they will come in, and what they want to trade. If they are in and they were very fast and full of energy, and then we will see that. If we are very concentrated in focus of one market, we will see that. But it's not possible to predict any aggressor at any time. That's not possible. It's impossible. We can only rely on something like, there's liquidity. We will talk about long-term high liquidity, short-term high liquidity in a few minutes. And we can say, okay, market needs liquidity. So you are going to sell your whatever you have, your car, maybe to the next town where a market for this car is. You are not sitting in your wherever you live, in city or whatever, and waiting that someone is coming to you and buy your car. So if you want to be proactively and going to sell your car, then you have to go to the market where to the place where a market is, and in this case the market is here. Okay, but just to make sure that we are talking, that we understand this very, very, very basic stuff here. Ladies and gentlemen, I kindly ask you to take your time to go through this order book, because this is a standardized procedure all over the world. There's nothing different. It's everything the same. The auction is everywhere on this planet the same. Any questions so far? Okay. I started. I was with when I ended, and then I was as an institutional trader, and I first came in contact with an order book, a dome. I'm not sure whether it was TT or anything else. They have their Bloomberg terminals. They have the domes, and that's where I first saw this stuff, because when you, at least I'm talking about myself, when you start trading, or when I started trading, then you got a lot of information about trading, and most of, I must say, I'm speaking for myself here, is nonsense. And then Peter Davis with Jigsaw Trader started in 2000, I don't know, 9, 10 or something, to make a dome for NinjaTrader 7 this time, and it was affordable because TT was quite expensive for a retail trader like me, and therefore that was the first contact. And Peter Davis did a tremendous job, did a famous job. Peter Davis did a famous job with the Jigsaw Trader, although it is really, I gave up because it is too tiresome for myself watching the dome all day. Because I'm visual type, so I'm a visual guy, so I need some visualization of the market, what the market is doing. What I just want to show you here is the structure of the limit order book. It can answer all these questions. How much was traded? When was it traded? At which price was it traded? Was the price accepted by the traders? Which side wants to buy? Which side wants to sell? Are they incoming aggressive buyers or sellers? And it shows you whether an instrument you are trading is thin or thick. I think this is quite important, even if you are really, because I have discussions with traders who are seeking, discussion with myself is that every one of us here in the room, every one of us is an individual. So maybe some of us are more patient than others. So and that has a direct impact on what you are trading. If you are not patient, maybe you need to trade NQ or CL or other instruments, cryptos maybe. But if you are patient, then the treasuries might be the right way to trade treasuries instead of thin instruments. And maybe you are using option to trade, what is recommended, using options to trade stocks, for example. We have always the same answer. We will try to answer questions we have tried to answer this week is we need to find the sweet spots. I call them sweet spots, where our risk-reward ratio is the best, should be the best. That's what we are seeking for, what we are looking for in this trading. And the structure of the limit order book is standardized. Therefore, you should understand liquidity as the resting liquidity on ask and resting liquidity on ask and resting liquidity on bid, and in between this are aggressors. Please interrupt me if you don't understand, if you can't follow, or maybe I'm too fast, whatever. As mentioned, this is not a monologue, or shouldn't be a monologue at least. I showed you, and that's important, I will go very quickly through this foils here, just for your information. As I showed you, the aggressors are colored green, and the limit of ask or offer is colored red. That means these greens are buying from red. The sellers, the these guys who are sitting on ask, they are asking this price and they're selling to the greens here. And that's the opposite side of the book. The reds here, aggressors, are marked red. They are selling into greens, or into this, into the limit, resting limit orders. These are patient traders, like you and me here, who are waiting until the price comes down. And then if we sitting there at this a certain price, we got to fill. Or we are matched and then we are in the business. So I added quotes delta. I added the quotes delta to my book Dome here. By the way, you can get the setup very instantly in a second. I will show you that during the next days, where you can download all these settings for free, and you can apply it really in 5 seconds if you want. So they are selling right now here. Where is the? This is the price is here, 82.50, 82.50, and you see this red. They are selling into bids, and the greens are buying from ask.
Walter, the quotes delta, can you explain what's
Yeah.
negatives and positives?
The quotes delta is measures is very simple. It's a very simple mechanism. So when you are using the Dome, and maybe you are using, that's because I'm coming from Jigsaw Trader. Yes, adding or subtracting to bid offer. Yeah, that's simply an very, very simple mechanism where the quotes delta shows the current adding. Look here, 100, 190, 100, and so on. It's quite fast. So that means they are on these 5 levels here. I'm just measuring the 5 levels based on best bid offer here. Here. It measures how many contracts are added, or how many contracts are subtracted from these levels here. Just put this up. That means you see that right now here they are currently adding 100 to the bid, and if that goes constantly up, you see always 100, 100, 200, 300, and so on. That means this is a kind of support. That's a kind of support. Yeah, thank you, Chris. That's a kind of support. Otherwise, and there's a wonderful pattern, I love it, I call it the lure. It's a wonderful pattern when the price trades into an area at a certain price, and then they are simply supporting that on bid. You see liquidity on ask and you see liquidity on bid. They are making the buyers, they try to make the buyers buying, because they are trying to support the bid in order to catch or to trap these buyers into a certain price. And then after maybe 30 minutes or whatever, 20, 30 minutes, based on, I'm talking about ES, they are simply canceling everything on the bid and the price drops. And these buyers are caught, their stops are hit, and this, when the stop is hit, then the price accelerates, in this case to the downside. And you can see that when you are watching the quotes delta. So like here, it's a little bit too fast, but it doesn't matter. You see they are subtracting minus 100. That means the bid side is weak. The bid side is weaker than the ask side. And when the bid side is weaker than the ask side, it means there's more pressure to the downside here, maybe into this institutional level or the settlement. Yesterday's close 78 here, where it was, maybe they are going to trade into the gap here, 78. Not immediately, but anyway, you see how they are trying to fight now, right now. Adding 100, subtracting, then the pressure comes on the ask. When they are subtracting, that means they are vulnerable to more upside, or the price will go up. That's the meaning of quotes delta. It's a simple mechanism. This is really nothing. There's simply nothing what we. It's nothing special we need to talk this about. Just to give you an idea what's behind. I don't have that on NQ because NQ is extremely fast. I don't have this on thin instruments. I'm just watching the ES. ZB as well. Oh yeah, ZB, look here. Nice, good point. Now here, that's the extremely, I recommend to trade soybeans or ZB treasuries, because if you are patient enough, you can get first every fill, and you can make good money with them. So you see what happens here. This is resistance on ask. Sebastian, I'm not sure who asked right now. Eve or Sebastian, whoever asked. I'm sorry for that, guys. Missed that. I just heard a voice. But you see how they're resisted on ask. That means they gave resistance on ask. Now they are trying to support on bid here. That's the current picture. You see how they're adding 352 to 160 and 17. Yeah. And they have trying to lift and to support the bid here. So any questions to quotes delta or to the dome? Do we know exactly how the CME? Yes, there's a web page on the CME which describes, there's a page on the CME. Not sure if I can find it immediately. There's a CME wiki, and you I can't find right now the page, the link. Yes. No, we have not only FIFO, we have more than FIFO. We have different entry techniques, but everything is described on the wiki of CME wiki. So I can't. Yes, we can do that offline. I can't find a link right now, but the most of all this stuff is described on CME wiki. Okay, let's go very briefly to this stuff. If you have questions, please, I urge you, please cut in and talk with us. Talk with me, talk with us. Don't be shy. There's no need to that you will hold back your questions. Put them in the chat. This is your seminar. This is your time, and I'm spending my time with you to show you what is really important for you to understand the market better and better and better. Limit order, what it is? I think limit order is an order on the limit side.
I have a question.
Yes.
The column in the middle there, VP, it always confuses me. Is that like it's the historical market data, the historical trades that have been made, right?
Yes, yes,
Yeah.
that's what's indicated here in the aggressor volume here, aggressor, yeah, excuse me, aggressor part. The nice thing is that was the you can nicely see if you're watching and setting your dome. It doesn't matter whether you have Jigsaw. It doesn't matter whether you you will put a dome on Bookmap. You will see very nicely the statistical outcome. You see here at 92, I'm not sure, 92, very nice resistance here based on this green bars. Let me just, here, this green bars, you see that? This is all historical what happened, but this is how a dome works. Well, this is really nothing, at least to me, nothing special. You see the historical data here, but what you can do in Bookmap, and that's one of my secrets here. You can click into this column here, into this aggressor column or SVP column. I renamed that aggressor column, and wow, magically everything is gone. So you can reset it at any time just to see better what happens right now here in this case. One wonderful dynamic iceberg order here. We will talk about that. But you can reset all the time this aggressor column here and get rid of the historical data. The SVP here as well, you can rename that. So to get a better description.
So that column represents anybody who hit market order.
Yeah, these are market orders, yes. We are hitting the bids, we are lifting the offer. These are market orders. And yeah, therefore I would like to encourage you to watch it. It's free, it doesn't cost anything. You don't need to spend any cent for this dome or wherever you are. Maybe if you are with NinjaTrader, you have to buy the license to get a Superdome. If you're with Sierra as well, you have to pay monthly charges, I think, for Sierra to get different.
But the one question.
Yes.
When you mentioned NinjaTrader, on not the dome, but the level 2, how they represent it. The way they're represented, I know. I'm just trying to clarify. Are these prices going off on all these levels because the spread is there, the size is there, the depth is there?
You are talking about Ninja?
Yeah, Ninja, the level 2 quotes. Level. Oh, let me try to see if I can put a picture.
Mm-hmm.
Okay, hang on one second.
Hey, Walter, this is
Yeah,
Frank.
Frank, hi.
Hey, I got a quick question for you. Do you, in the aggressor column, do you double click and clear that out fairly frequently during the day?
No, I don't do that because sometimes, like I did it right now here in this column. Sometimes it's quite interesting to watch this bars here. So they are relative to the volume traded, and as I showed you, there was a high volume traded in 92. I think it was 92. So I'm sorry for that. I don't delete them because they can be of value when we are considering and watching the so-called resistance or support areas. These bars are relative to the volume. I think it's the same for Jigsaw as well. So you can do that as well in NinjaTrader. But I don't reset them because simply of the fact sometimes it is necessary or sometimes it is valuable to see to watch the level where the relatively seen the biggest, let me say, the biggest bars are. Maybe to see that that was a support, it was a resistance. So I don't do that. Let me see.
Okay.
Let me see the picture whether I can open it.
I was just curious if you do that when you're getting ready to execute a trade, just to see if you're seeing a lot of support or
no. I will show. We will discuss other techniques how where to trade, where to put this trades on. Just this is quite interesting if you want to understand the big picture. But when I'm a trade, let's see. I would. My intention was to see this gap, the institutional level, the years are close, go long here. So when I'm in a trade, I'm focused on the trade. Where could be the next target and so on. There are a lot of questions during a trade. I'm not watching the aggressor volume here. The only exception is, but on the other side, TradeFinder will show you that, is when we see a sweep and volume spike here, for example, which means exhaustion. And we will talk about the price dynamics here as well.
Okay. That's good. I'm just curious.
Yeah, that's okay.
Thank you.
No problem.
Well, I'll try and put the picture.
Yeah, I'm
on
trying to download this picture. Yeah, that's NinjaTrader. So what was your question again? Hello, Julas? Hello?
Hello?
Yeah.
Hello, dear.
Yeah.
Okay, I'm sorry. So this is a picture, but on the live version, like everything is going off at all these levels, right? Is that the same thing when they take off contracts and put on contracts, or is it because there's a spread here also? So I'm a little confused. Where does the price go off at that price level?
Yeah. I'm sorry for that. I'm not using level 2 here in this case because I think you have kinetic or rhythmic data. What data is this?
This is kinetic.
Yeah. The point with kinetic is that they are providing aggregated data. So sorry for that. Aggregated data. I think we should make a break now, just to relax a little bit. Yeah, but it's not the same. You see the spread here. You can use the spread as well if you are accustomed to this picture. Yeah, then you can use that. But I can't say anything meaningful to this level 2 of a NinjaTrader. So I'm sorry for that.
No problem.
I haven't used this practically in my trading because I'm watching the NinjaTrader Dome. I have here. I can show you what I have here. Just a moment. This doesn't work. So I don't know. And it's gone. That's what I have here on Superdome on NinjaTrader. I have Jigsaw, but I didn't start the Jigsaw as well. So it's maybe a very similar picture, but I'm not looking at a spread, just seeing how to say, we will discuss that and I will show you what I'm looking for. I just want to see the sweet spots here, and then I'm trading and not looking at a spread right now. In this case, for the years, maybe the spread is important for other instruments, not sure about that, but I can't say anything meaningful to this level 2 of NinjaTrader.
No problem.
Okay, guys, so limit order, what it is, I think it's clear. Market order aggressor, what it is, I think we talked about that as well. I put this in this documentation just for you to go through and to make sure you understand this really important instrument of an order book, because it gives you so much information back. You shouldn't miss that. Cancel an order, what is, yes, and that's quite important when we are coming to liquidity in a few minutes, is canceling an order, what it is. What is it? Oh yeah, that's a typo here. We will constantly see that the orders are cancelled in a book. The problem with it doesn't matter whether you have level 2 EULAs or you have a Superdome or you have Jigsaw Trader, whatever dome you have. It is so fast that you can't. A human eye can't see what happens in the book in milliseconds then, and therefore. The visualization, as I mentioned, I'm a visual guy. The visualization of an order book is extremely helpful. It's helpful to see what really happens in the book. When either the bid or ask queue is depleted by market orders and cancellations, the price moves up or down to the next level of the book. This is as well to answer your question. There was a question about the quotes delta. You see the depletion of the book in the quotes delta here in this column here. Hard to see for NQ if you are trading DAX, German DAX. It's impossible, but you see that very nicely for treasuries here. If something is cancelled or added, you can't follow that really easily with the quotes delta column here. So quotes delta, nothing new really. It's called quotes delta. I think Jigsaw is calling it a little bit differently. And don't snap. It's a snapshot column in Jigsaw. You remember this? Maybe we have had a look a few minutes ago, and then I talked about quotes delta, and we saw they are adding 400, 500 constantly around this 16 or 70 level here. Can't remember that anymore. But in this case, it's really worthwhile and meaningful and important to have this quotes delta, because it shows you with this instrument that they are supporting this level. And when a level is supported, be sure maybe that this price will stall or come to a break or need a pause, or maybe even comes to an end. That's the meaning of the quotes delta. It's, as mentioned, it's hard to follow in very, very fast instruments, or for very fast instruments. Okay, limit order book dynamics. I would like to skip that, because the only exception is if you have questions, because I put this into the documentation for you on own knowledge, to come back to get a very quick overview about the limit order book, how it is built, and about the dynamics. And we see this dynamics all the day in the book. It's flickering up and it's flickering all the time here in the S. And it gives us information about the market. But will be very, very hard. Let me say that very openly. It will be very hard to follow this information all day. You can't watch these numbers going up and down, but for maybe for 5-10 minutes, okay, but not the whole day, in my opinion. So it gives us information. We understand the auction, we understand the auction process, but we need look here. What happens? They added 1,000 contracts at 84. And suddenly, in the book on the ask, and we will talk about that, and then they canceled that immediately here for some reasons. That's what we want to see. That's what we want to understand. That's the language of the market language. And then this is what guides us through the trading day when we are in, when we see the reasons, when we find our sweet spots to execute. Okay, LOB excuse me?
Walter, one question. Did they cancel or did they get consumed?
No, they cancelled. Here.
Oh, you're able to tell?
They cancelled.
Okay.
Clear cut at 5:01. What is this? This is 11:01 your Eastern time at 84.
Should then be there a minus number from your indicators?
I
see that all the time.
Yeah. Good question. Excellent question. Would you mind make a notice and send it to support@ttwtrader.com? It would be very helpful, because you are right. We did it for the relative liquidity. We will talk about relative liquidity. So when relative liquidity comes in the book, I don't see anything right now here.
What time is it then, Walter? I should write about. Exactly.
It's my time 5:01. It's 11:01 Eastern time.
5:01, yeah, European time. Okay. Okay.
Let me just check this. Yeah, okay, I did it wrong here. Oh yeah, okay, I have had the wrong number. You see, we will talk about this changes in the book. It's impossible to see that in the DOM. Therefore, we added this guide for everyone who wants to see that and understand. We will talk about that maybe today or tomorrow. We will see that. Okay, DOM on chart. Yes, that's exactly what I have here. And I would encourage you really to put it on your chart. It doesn't cost you it costs you nothing, but it gives you the maximum of inspiration, of course, and information as well.
Hey Walter, this is Frank again. I think the reason you can tell that it's cut off and not consumed is because if I'm understanding Bookmap correctly, you would see dots that are actually touching that line showing consumption, yes. But you actually see a break.
Yes.
And because of that break, you know that it was canceled versus consumed.
Yes.
I think isn't that the way Bookmap works?
Let's just take a minute for this, what we talked about here. 84. And therefore, guys, you will see how great the idea of a DOM is. You will see that. Look here, 4684 even. 4684 even. Here. You see what we have in the book. 158. And currently at that moment when I slid this, the workspace towards right, we have 223 traded at 4684 even. You see that? Everyone with me on board right now. We will make a short coffee break So be with me for the next few minutes. We'll take a coffee break right now. So 46.84. And now go back. Now slide the workspace towards 84. And you see what happens here. That's the point. You know, when you are, the Bookmap has an invaluable function that's recording. I encourage you to record every day, every session, your instrument, stock, future, whatever it is, it doesn't matter. And then have a look here, it's 46.84. 46.84, and you read 1,213 contracts on Ask. And when we are going back to the beginning, I don't know whether I can find it. So at that moment, 46.84, we have had only 96. And suddenly, someone comes in with 624. They added nearly 600 contracts at this time. Then we are sliding this to the left, or moving this chart to the left. And suddenly, from this 600, the 600 became 1,100 or 1,200. Yeah. Or 1,180, whatever. Guys, that's not something we can really make blindly money on that. But this is an information. This is some real-time market information. This is real time. So now 1,213, as Frank said, mentioned, they cancelled it at this point. And this is as well an information of the market we should not ignore. It's not maybe when we are in a trade, given this is our sweet spot here. We entered yesterday's close, the institutional level, and the gap here around 78, and we are just hoping then for more. But we should be very cautious when we see this behavior here, around 84. Maybe we got 4 points. That might be a good outcome. Okay, we live and DOM and chart. Okay, we talked about that. And before we proceed with liquidity, volume, price, dynamics, and so on, I would suggest to make a break, okay? Let's do a break not longer than 10 minutes. That means let's come back latest and 11:20 Eastern time. For the European guys here, 5:20, yes, European time. And then we will continue to discuss liquidity, volume, and price dynamics. Okay? When we talked about the goals of the seminar, I just wanted to make my goal is to show you how you can be confident in your trading. Okay, liquidity, volume, and price dynamics. This is the next point we should discuss and see live on the chart here. I think you understand right now why liquidity and volume, why the understanding of liquidity and volume is important. Why to make the difference between liquidity and market volume, or aggressive volume, if you want to, if you want it that way. Just a very clear statement. I think it's very easy to understand, but I repeat myself. This is a slide from my previous presentation, that liquidity is the blood of all markets. I mentioned that, and we talked about that, the importance of liquidity a few minutes ago. And by the way, liquidity, it doesn't matter when we are talking about liquidity in the trading, or liquidity of providing vegetables, fruits, other goods, or cars, other appliances, whatever we are talking about. There must be a certain liquidity, and there must be a price who is, the fair price for a certain good, and liquidity must be established, and must be in every market, available for every market. It is applicable to all markets. That means futures, stocks, ETFs, and without liquidity there is no trading. We will see, and we discussed already a little bit about markets of liquidity, if it provides liquidity based on the quotes delta or not. A very nice example we saw right now based on liquidity, and based on liquidity was here the liquidity at this is ZB, Z1, that's the 30-year bond. Yeah, ZB, Z1, at 160.16, where this quotes delta supported the price here. The price bounced back a little bit. And then now you see there's a pressure on the ask. That means that could be really hard here for the price to rise further. We will see that. But it doesn't matter. Liquidity will, yes, acts as a support or resistance. And liquidity always attracts the price. Let me show you an example, a live example here. Liquidity always attracts the price. We will establish a rule based on this liquidity, or based on liquidity, not this liquidity, but based on liquidity is the market started. The market started, and we saw liquidity first of at 46.85, then 46.80, and then 46.79. By the way, before the open, we will talk about the institutional levels. They are amazing, simply amazing. This is not my invention, or this is nothing I'm promoting, selling, or whatever I'm doing for that. I'm just sharing that. Then they are based on options, and when we are watching these levels here, we see how important they are for the daily trading. Some days they are working extremely well. I would say the statistical probability for the successful trading based on institutional levels is maybe 70%. I have never tested it. It's just my opinion on that. But you see, liquidity is always a magnet. Liquidity is always a magnet. Please keep that in mind. It's a simple sentence. It's a simple sentence you should keep in mind. Liquidity is the blood of every market, and liquidity acts as a magnet. You see, the first target was 85, the second target was 80, 81, and the third target was 78, 79 here. Based on pure liquidity. We are not talking about anything else, just liquidity. That's really amazing to see and to understand this liquidity concept. So liquidity and attracts the price. Liquidity is easy to manipulate. As mentioned before, it can be cancelled in a second. It can be added in a second, not second, but maybe millisecond. As you can see, we will talk about this phenomenon here, because this is a language we must understand. We have absolutely changes and relative changes. Look here, what happens here. And liquidity can disappear from the market very, very fast. And therefore, there's always a practical discussion between those who are using the ordered book, or the DOM. Maybe especially Peter Davis is very busy with jigsaw trader, because it is really hard to, as I mentioned before, follow the pure order DOM. For some of us, of course, maybe not for all people, for all traders, but for some of us, of course. Okay, good. Liquidity is a constant. Liquidity is the blood of the market, and liquidity acts as a magnet. Who provides liquidity? I mean, everyone. We can. Let me just see. There are some questions here. With so much to focus on, you feel liquidity is... Yes, Chris. Liquidity is the number one, because without liquidity there is no life. Period. That's really simple. Where do you get the instant level from, Walter? And do you use program? I'm not talking about my sources and my associates I have who gives or provides me the institutional levels. They're coming from a big institution. That's for sure. Therefore, I'm calling them institution levels. I'm using spot gamma levels as well, and most of the time these institution levels are coming or crossing or sharing this spot gamma levels on some days. I'm not sure. I think Jay knows that for sure. When you're on Twitter, I'm following Cem Karsam. Not sure if it's known. If he's known for some of you, but he's a very good options trader and great options trader. There are several other. Cem Carson. Yes. Cem Carson, Carson. Not. Yeah. I think he is it. And I'm following Perfiliev. That's a really nice guy. I will meet him next year. And yes, you must follow them. And you will see that sometimes Cem is providing some levels or posting some levels. And these levels are very close to that what these institutional levels are. We will talk about that, but I can't explain more than I have. I'm sharing them for free so far. I'm on Twitter as well on in the Discord room as well. And what you see on my chart, this is a voluntary work from, in this case, from Chuck, who is adding this to the cloud nodes, and these cloud nodes are for free. Who provides liquidity? First of all, every one of us here in the room can or provides liquidity. Given you are sitting on a liquidity level or on limit level, on a resting limit order level. Let's say you are buying, then you will sitting on a bid, or you are selling, you will sit on the ask. So every one of us is a liquidity provider in the sense of a positive meaning. Negatively meaning we are as well liquidity providers, because when we are losing, we provide liquidity to the market. So we must stop losing money and be the liquidity providers. We should be liquidity takers. That means we want to be winners in this market. But anyway, first of all, we can say we are liquidity providers, of course, but even when we are talking about 100,000, 2,000, 200,000, and so on, retail traders in the market, maybe a little bit, maybe more. So they are split in between different market stocks, future markets, and so on. It is for sure not enough to provide all the liquidity we need to get first the best fill and to exit the market without any slippage. That means we need to have a sound and good liquidity in every market, and that's the goal and the task of option market makers, because they make it possible for hedge fund, pension funds, portfolio managers, and other market players to trade their option against the option market makers. They are providing this thousands and thousands and not millions of contracts, whatever we need for different markets. So these big option market makers are playing in completely different play. What we are doing here, we are retail traders. And what we are doing here during this seminar and the next days and the next weeks is to understand the market mechanics and try to find the best, yes, I'm calling it the sweet spots. I love this expression, sweet spots, for us to trade either in day trading or to make money in day trading, or to to hold a trade maybe during a few days. So that's possible, but that's possible for sure. That's feasible. Yeah, of course, it depends on your market view. Of course, that's important. But we want to we want to trade the market. We can't provide 500 million, at least I can't, 500 millions of to sell into shares or to buying to make my delta to keep my delta neutral. I'm not in the position to do that. I'm sure some other hedge funds are even not in the position to do this. Even the pension funds and other funds which are around here. So we rely on this big guys in the market who really provides this liquidity to us, and this big player is this option market makers. Let's call it a big player. There are for sure different big players in the market. They provide this market makers and hedge their residual exposure. So if we are thinking metaphorically, we can say that this big player represents all dealers and market makers in the SP 500 option markets. And hedging of options is mainly done in the SPX. We will talk about later on tomorrow, or maybe on Wednesday as well, and stock market. But this hedging has an impact on the E-mini futures as well. So be sure that we rely on other players in the market who has more who are better informed than we, who has better weapons, who are strategically better positioned than we are. So at least I'm not in the position to, as mentioned, to play and to trade 500,000 contracts a day. But these guys for sure are to move $500,000 or $500 million, or even $500 million a day to keep their exposure as low as possible. Just one word. I added this slide intentionally to the presentation to make following clear. When I started with Pesavento and Bryce Gilmore, then these guys have been traded, were trading the harmonical patterns for years. That means they have been in the market in the 60s and 70s. And they told me, or I learned from them, that at a certain time, I don't know whether it was the 80s or whatever years it was, they have to trade the cash market, the SPX cash market. And that means they have to, for every contract they are buying or selling, they have to pay, I think it was $500 a turnaround. $500 a turnaround. In other words, not everyone was in the position to trade the SPX or the cash future, because it was so big, it was so enormous. So you have had to have a lot of money to trade a contract in the SPX future. That's maybe also if we come together and for a beer or whatever and discuss why is Elliott Waves is not working today, not so as it worked 20, 30 years ago, or Mr. Mr. Elliott and the others who had brilliant ideas in the 20s and 30s. This techniques doesn't work reliably anymore because the market is fast, the market changed very fast, and that's simply the reason why these techniques are not reliable anymore. The idea to add this just to bring it to your attention is that the contract was the CME at the E-mini, and E stands for electronically traded future, that was introduced in 97. And the idea was to open the market, this trading market, for the normal people, for us, for the retail traders. Because the SP contract became too large for many small traders. And the E-mini quickly became the most popular equity index future contract in the world. Then the Nasdaq came up, mid-cap 400, and so on. You name it. And I think it is really not hard to understand why they opened the market. What do you think? Why they reduced the value of the SPX to the E-mini, and today we have the micro. Come on, guy.
They needed liquidity.
Liquidity, and what else? When you think about this industry, so the exchanges, this is a multi-billion-dollar industry. And I tell you what, every cent counts for them. Every single cent. Commissions, right? They want to make money. They want to make us to pay commissions to them. They want to make us. They are selling information like data feeds or data. No, not data feed, but data. They are demanding 1 small cent for every turnaround. And you can imagine that opening the market to the E-mini and now the micro is nothing wrong. It's great. But guys, we are the prey. Be sure we are the prey, and we want no longer to be the prey in this business. That's what we should try to achieve this week, and hopefully I can help you to achieve this goal this week. So be sure that the opening the markets, Frank. Opening the markets for us, for the retail traders, is simply luring us in. Look at the crypto market, how insane this crypto market is. That simply, watch the, what was the stock? The I think it was GameStop. What happened? What is happening with this markets? This is simply to get your best. The market wants to have your best. And that's your money, guys. That's your money. So, yeah, that's your money. They want your money, and therefore they open the micro market. Although, I must say, the micro market has a big advantage because it gives you the chance to start trading without the fear to lose a lot of money. Okay, so far to the liquidity. And why is liquidity important? Because we will understand in our strategies that liquidity is the main part, and that was a comment from, let me just see here, Chris. Yes, it was a comment from Chris here, that liquidity is the main focus we should look at. That means for futures, stocks, ETFs, whatever. I don't have any experience in cryptos, so I apologize, I can't talk about cryptos here. But as I see on some Twitter accounts, on Twitter messages, tweets, cryptos as well has liquidity on their charts as well. So liquidity is there. If without liquidity, no trading. How to analyze all liquid markets based on the actual daily long-term high liquidity and short-term high liquidity. We will see that. We will understand when liquidity deteriorates, is added or cancelled, and is used by short-term big players to position themselves in the game like chess. That's quite important. Maybe you are following me on Discord, in our Discord room, TDW Trader, and Doug is a friend, and he is just commenting the market perspective and view from his view, how he sees the market, and he's sometimes saying, okay, watch 70, watch 75, watch 40. Maybe you can remember if you're following or you were part in our channel. And excuse me. And that's because some big players are just canceling, adding. Look here. You see, hopefully you see my screen. 46.90. We have had 100 here added at 46.90. Then suddenly we have added, we see an addition on chart here at 46.70 plus 75. Then we see 60 cancelled, that was for sure before. Then added 50 here at 85. Cancelled 50, added 300 here. Guys, ladies and gentlemen, look here, 64. This is a language. Maybe some of you are following National Geographic Channel, and then maybe when you watching their channel, there are some nice documentations about humpback whales, and how they are communicating in between. Simply they are communicating by, I don't know, singing, sending a sound, and that's what you can see on chart. That's a part of the liquidity tracker, and therefore I see that's really the Trade Finder is a genius tool when you understand what to look at and what to see. So the cancel, look here, they cancel immediately 50 and added here 64. This is at least not me. Or maybe some of us who are really in the position to add add silently or hidden orders in the book, 50, 60 or whatever. This is a strategical approach from someone, whoever it is. It is hard to discuss. You can call it a big player, small player, he, she, it, diverse, or whatever you want to call them. And they are placing their orders around in the book here. If something happens like this fast drop down here, what it was, I don't know, I haven't listened, maybe there was a message or whatever, I don't know, it doesn't matter. Then you see how they are positioning themselves here in the book. It doesn't mean that they want to be or will get hit here, but it's most likely that maybe the 64 are traded at 67 because of the volume here. That's what we need to understand, what we need to see. Not to speculate, who is this? This is Goldman Sachs, and this is another one. And we don't simply know who is behind these activities here. We can't only add one and one and one and see what might happen or what is going to happen. You see liquidity here, you see liquidity here, you see liquidity there. So, options are an important part of our trading. Not that we are. Maybe some of you are trading options. No, to me, I'm going back to the questions here. Was there anything on Bookmap or your tools that might have?
Yeah, I got one
Yes.
question, Walter. Whatever they added, that plus 75 plus this minus 64, can we assume they're all limit orders?
Can we assume? Excuse me, all?
They're all limit orders. That's
Yes,
liquidity.
yes.
So it's all they are all. So they are not market
Yes.
orders. They are all
Yes.
limit.
Yes.
Okay.
Let's see if we can see that.
Yeah.
46.70 was 199. Oh, yes, 199. Let me see. Yes, it jumped up to 384. So this number, others are joining this 70 level here, but we see with a blink of an eye here, we see immediately when that happens, the price was, by the way, here at that moment when they added 75 and the price was far away. So that could be as well a very nice hint of the market that they are trading 70. But to answer Chris' question, was there anything? No. On book or your tools that might have predicted this drop? No, there was nothing. what we we didn't spot that, but we can see back the market volume increased here dramatically. That's what we could maybe see here. I'm recording this event here. That that could be a point where we see that they broke to this, they absorbed this level here at 79, and they broke to this level here. But there was no sign before for anything that this mark is going to drop so hard at this time, 11:41 Eastern time here. There was no hint. What we can do in this case is just watching, look here, this high market volume, 3,800 right now.
Hello,
Yeah.
Walter.
Yes,
As I've already also written in the chat, as far as I can see now, I'm looking in Bookmap at the NQ at the moment. But if I look at the stops, which they are always for me a very good indication. You see a very big stop run just before the whole thing comes down, and you see these things happen all the time. Stops are, for me at least, a major indication of things happening.
Yes, Raimo, I think you are talking about this move between 535 and this move here, right?
Yeah, correct. It's, to be exact, it is in NQ. It is I think 17:35 and then 33 seconds. Yeah, and that's when they had a big stop run, and afterward it comes down. This is something that I've learned over the past 6 months, that stop runs are really a major indication of the big players playing around with retail. They take out the stops and then they make their move.
Yeah, Raimo. Yeah. I know what, I suppose you have the SI tracker and here's indicating the stop runs here, right?
Yeah, well, actually I use, as you know, perhaps another indicator for it, but yeah, it is. I can.
No, that's
image,
okay. Just, yeah. I understand what you're saying. You are saying these are stop runs here into 82 and 84.
Yeah, well, I'm looking at NQ actually.
Yeah.
So, and in NQ it is very obvious. Yes.
In NQ we have had an sweep into this area here, very nicely to see a sweep, which could be, yes, which is maybe a stop run. I don't see anything else. The point here, why I'm a little bit cautious with I know what my colleagues are doing here, and let me say that you are considering this a stop run.
Well, it is being mentioned as a stop run by Bookmap itself. So I guess your indicator is mentioning is taking it as a stop run as well, right?
I don't see a stop run right here because let me you know, Raimo. Yeah, the point of a stop run, the meaning of a stop run is to get straight up, hit the stops, and then reverse the market. Please. Tell me if I'm wrong or not wrong. So when a stop happens, let me try to find maybe another. We don't have anything else here. I know, Raimo, what you are saying, what you are pointing at, but I'm not happy with this explanation based on from my colleagues here from Bookmap, because I know the SI tracker, and you will see this by an explanation on Twitter. SI tracker is maybe showing some small little squares up here into this area. Raimo, please correct me if I'm wrong.
Are you okay?
Are you okay with me sharing an
Yes.
image?
Yes.
Yes.
Yeah.
Okay, I will do that now.
Okay, just share.
Okay, just shared the image.
You can take a look.
If you can take a look.
Yeah, I see that. That's the point. That's by no means.
You see it as a big stop run,
And they take it a little bit higher.
Oh yeah, you are talking
then
about NQ. That's NQ.
Yes.
Okay, NQ. Yes, that's not a stop run. That's a sweep, Raimo. I know this. And let me show you. That's a sweep.
Yeah. Okay.
Yeah. Okay. Well, Bookmap is calling
Yeah,
it a stop run.
because they don't have any.
Yeah,
I'm sorry for that. Just I don't want to blame them, but that's a sweep here. That's the same 70. Let me say 70-35. Yes, that's a sweep here. That's a sweep here. You see, we have it's the same here.
Walter, isn't a sweep considered? I mean, a stop run. Isn't that technically a sweep?
No. What they are doing is simply because how to say, that's really a critical situation now, because it will come on tape here. They call this a stop run here, but it is not a stop run. It is simply an absorption. In this case, what Reimer is showing us, that's a sweep. That means a sweep is a single order ID who sweeps through a level of ticks or prices. That's what Reimer is saying. That's correct, but it is a sweep because that happens in one order ID. And by the way, the Bookmap guys are copying us, not only with introducing the Telegram, but you see the newest edition of Bookmap is the sweep and absorption indicator they are doing, and they saw based on TradeFinder that the sweep is something else than they are trying to tell us or telling the people who are listening to them. Reimer, you are right, but that's simply a sweep what happens here, and you can see that as well here on the MVP. You don't need to spend this very expensive indicator. You said it here, and the TradeFinder is saying that's a sweep. That means this is we'll talk about sweeps in a moment. We will talk about sweeps in a moment. Yes, that's an absorption, and when absorption happens, there happens exhaustion. It's not at the top. What's a little bit more? It doesn't matter. But you are right. My view, and I want to tell you simply my opinion on that, is that is. Let me say it in other words. My understanding and my experience with stop runs is that you are going to hit, to go against the market. I don't have a very nice example right now. I don't have a nice example, a good example. You're going against the market, and then this 2-point up move or 2-point down move triggers stop, because retail stops are mostly 2 or 3 points. Let me say 3 points. So the market triggers the stops in a very fast up move. And then what happens when the stops are triggered? Yes, it should come down. Yes. Yes, absolutely. Yes, that's the point. They are coming down. So they are, when you want to trigger the stops, you want to get the opposite move, but you need some acceleration of this move. And then these stops are simply executed market, and that moves the market very fast from the triggered stops here. That's exactly. So, and that happens. We can see that, but I don't agree with Bookmap, because I'm sure they don't have any clue what a stop run is. So, and what I wanted to say at this all of tape, I think I should cut out this from the tape here. Now what happens is following. They are using the SI tracker, and the SI tracker shows some small little squares here. Let me say where you see my cursor, and that they are calling, as my colleague Doug P is calling that, a stop run. But please keep always in mind, Bookmap is aggregating data. These are all aggregated data here. If you want to see if this is a stop run, you have to zoom in. So we see here, and this was a very nice iceberg of 300 here as well here. In NQ we see this stop run where it was. Very good point. It's always an attention sign. Be very cautious with that. And in ES or in every bookmap chart, don't believe that. Zoom in and see what happens. We will talk about sweeps in hopefully today or latest tomorrow. And you will see what I mean by stop runs or by sweeps, why they are important. Because this is by no way a stop run, because this is simply volume traded up. So they started at 82 and they traded, you see the time scale here. They needed 35, 1 minute to trade into 83, and then the next one, I don't know, here. That's the time. And when you zoom in, it's simply traded volume. There's nothing surprisingly here, nothing, really nothing.
Yes, but this is the ES one,
yes,
not the
yes,
NQ
that's the
anymore.
ES. And the AQ, let's drill into a Q here. This is the sweep, we call it the sweep, and then the market accelerates a little bit more. If this is a stop run, then the market would trade back down, but it does not trade back down. It trades simply up, goes a little bit further up and comes to a stop. That's a kind of exhaustion here in the market, because there are no more buyers who are willing to lift the offer at 195, and then the market slowly break down or trade it lower, because simply there are no more buyers at this point. So I'm and then drop down. If you can use it, of course. What you're saying is okay. That was a stop run. We call it a sweep, and then there are run out of buyers here at 190. I'm very cautious with that what my friends at Bookmap are telling the people, and when I see this on Twitter, I'm showering a little bit, because I'm sure if you want to see that, zoom in and see what really happens. We will see this. We will have this discussion with the sweeps here. So that's the point. The question is, let me just go back, Raimo. Give me a second. Oh, just lower highs. Raimo, there was there was a traded iceberg on NQ. We saw a sweep. MBO stop date. I don't know what you mean, Chris. They don't ever label sweeps. I don't know, Chris. I don't know what you mean with that. What I want to know is when to trade with sweeps and stop. Yeah. Let's put it back, because we will talk about sweeps here. Just to show you that this drop, at that point, I mean, hindsight, everything is explainable in hindsight, but at that point, you see sweep in NQ, you see high traded volume 81, and the price goes up. At that point, never, no one will know that the market breaks down so hard.
It's also in many cases a confluence of other signals, for example, the exhaustion or the absorption, etc. And I must say that I have some good entries when I see big runs, and whether you call it sweeps or stop runs, it doesn't matter. But if you see some big buys coming in, some big sells coming in, together with the absorption, etc., then you, in a lot of cases, then you see some big moves.
I understand
so that was actually.
We will talk about this phenomenon in very, very shortly. So let's keep up this discussion when we talk about sweeps and volume spikes. We cancel the expression stop run, because volume spikes are better to understand, and they are going in the same direction. So maybe we will find something, but let's keep let's stop the discussion. We will come back when we talk about sweeps. Okay. Okay, good. What I want to know is when to trade with sweeps and stop runs. Chris, be patient. We will come to that. Why is liquidity important? As liquidity deteriorates, the implied volatility moves higher. and liquidity improves improves when the implied volatility falls. And Raimo and yes, ladies and gentlemen here in the room, I will show you where you can get a 100% confirmation what the market is doing. I'm exaggerating a little bit, but only a little bit. It's not 100% because there's nothing 100%. But we will talk about this entry here from another perspective where you can see what the market is doing. Give me a little bit time. I will come back to that shortly. Just to get some terminology clear and straight. So when we are talking about liquidity, I think it's a good point just to keep in mind that we have several differences in the liquidity. We have a long-term high liquidity, short-term high liquidity, and spoofing or very, very short-term bidding or offering. That's what I want to say. We want to go deeper with the liquidity stuff. You understand how liquidity is important and so on. If you have questions, please bring it up immediately, because it is important to understand all this nice stuff here where we are talking about. Long-term high liquidity has I would say is priority. Priority number 1. Short-term high liquidity is priority number 2, and spoofing and short-term bidding or offering is priority number 3. That means long-term high liquidity lasts in the book for days. We have seen that weeks before when, I don't know, markets set on 44.50, for example, for 2 weeks, and the market traded around the 4400, 44, 43 something, and then finally hit 44.50 in 2 weeks. That's the short-term high liquidity. The short-term high liquidity, this is the long-term high liquidity. The short-term high liquidity is priority 2. It comes up like we saw here. That was an excellent example. I think this one here. That one where we talked about, I think it was cancelled. I think it was here. This is the short-term high liquidity. They bring up massive liquidity in the book. Oh no, that was this one here. This one at 84 even. So, and then cancel that. That's clearly short-term high liquidity because the liquidity was above 1,000. And spoofing and such small liquidity which comes up very, very quickly in the book and remains only a few minutes in the book and then disappears from the book. Just to keep it in mind, we should look for the bigger liquidity when we prepare for the day. And then just a moment, maybe I will find an...
You're not forbidden by the exchanges.
Sorry?
Now? Regular exchanges, I mean?
Excuse me?
Spoofing?
What is forbidden?
Spoofing?
Yes,
Spoofing?
it is. Yeah. So when I'm preparing for the day, I'm just watching the overall picture here. And then I'm seeing that there's more liquidity on the upside here. It's 4,700, but days as well as liquidity at 46.75. So we have a long-term high liquidity at 47.25. Even if we broke down here, I'm not sure if this is in book, 47.25. Yeah, the liquidity, yeah, it's still there. So even if we broke down here today, this 47.25 is still in. It doesn't mean the market will go straight up, and therefore it is. I hope you understand. It is forbidden to watch for the liquidity here and saying, okay, the market is going today to hit 4700, 07 and 25. That can be maybe in 2 weeks. That's not a conclusion that the market is going to trade straight up here. but you have an excellent view of the market conditions of every single market. That means, let me see Tesla, for example. Yeah, very clear picture of a stock. What's this? Very clear picture of a stock. Liquidity is down. QQQ. Yeah, that's a little bit more harder to watch because the liquidity is around the price, which was never before. But you see as well at the beginning on QQQ, and we will talk about QQQ and SPY and the WIX these days. You see where the liquidity is. It's hard to believe. That's really hard to believe. But when you see these constellations here, the first impression should be that the market is likely to trade into this liquidity. And you will learn, that's my goal this week, that we must look beyond the fence to understand what the markets are doing. You see how they drop down. Even if you watch the QQQ, you can use and you must use the correlated markets. Just keep this smaller here. You must use the correlated markets to get a complete picture of that what you are trading. If you don't get, you are lost. Good, that's QQQ. We saw Tesla based on liquidity.
Walter, in QQQ, can you go back to QQQ, please? Those blue or blues, small blues liquidity, blue lines.
Yeah.
I believe is that
No.
spoofing? They're coming in.
No, that's not spoofing. That's simply they are playing with this liquidity here. I just switched off this the hidden liquidity changes because it's too much. So the point here, what we see here right now in ES, let me show you that. I don't know whether we see this today. Maybe you can remember when you are watching the book map that the liquidity, there was a liquidity band, maybe 10-15 points around the price. So there was red above the price and red below the price. This changed in March this year very dramatically. Until then, we have very clear picture that was a liquidity here and there was a liquidity there, and everything worked fine. But since March 21, something changed. I'm not sure if this is really because these guys know very well that most are using a heat map, not only in Bookmap, but as in Sierra, as well in Thinkorswim, as well in NinjaTrader. I'm sure there are several other programs who are now copying or mimicking Bookmap and trying to establish a heat map on the chart. And a heat map is nothing else but a picture of the dome. And you can, when you understand the liquidity concept, you can predict the market to a certain extent. That means you see what happens. You see it's even impossible that the market trades here, but you see this big liquidity here. And Raymo, but by the way, one point which comes to my mind here, and Chris, was there anything on Bookmap or your tool that might have predicted this drop? If we establish the theory that liquidity is a magnet, if we believe that, if we can prove that, then the only possible way for the market was to trade into 79. Although we have here possible liquidity at 90, but the most probable target, first target, at that moment we don't know whether it breaks down or that was a message, that was a news or whatever it was, it doesn't matter. The most probable outcome, Chris and Raymo, to me, would have been this liquidity here at 79. because market needs liquidity to transact. Market needs liquidity to transact. And this liquidity was in the book for since here. What is this? 10:10 Eastern Time. You see how they added liquidity at 75, even if the market traded into 84, 85. It's hard to believe, guys, I know that. It's hard to believe. We are relying on microstructure here and see what the microstructure is telling me or telling us. But the liquidity was there at 79 and the liquidity was there at 75. So if the theory is right, that market needs liquidity to transact, then that will have been the trades, the targets for the day here. Some comes very nicely into this institutional level. I don't know what happens here. Yeah, as well here.
Walter?
Yeah.
Walter?
Yes, I would
Yes, I would only like to add that I agree with this. If you look, for example, an hour in advance or at the open of the market,
if you zoom out,
if you zoom out,
you see the
the big and the high liquidity levels, and that's where they tend to go. And the stops are usually an indication of the spot where they might make a go for it or where it might actually break through. Sure, longer term, you always have to look at the high liquidity levels.
and
don't make the same mistake as I did. I lost some money with it. That just thinking, okay, I place my order to go to the level with the high liquidity, because it doesn't always work this way. But statistically, the odds are with you if you bet on it. But don't go blindly all in.
Yeah, thank you, Dwight. Yeah, that's it, guys. So just it is like a map. It is like a map. So you start here and you see this might be the target, but the market makes us very hard. In other words, if you see here, okay, they must go to 70, the market must do nothing. So these are the levels of interest for today. It took 1.5 hour, more than 1.5 hour to trade into those levels. We don't know how fast this market or the move will be, how hard it will be, but it is really something we should keep in mind. And therefore I'm stressing this dome, I'm stressing the liquidity, I'm showing you how important it is to get the first impression, the overall picture. And in the second part, we will add the correlated markets to that picture. And you will see how genius this approach is. You don't need to go into micros and see, okay, there's an iceberg. This is another, Raimo, this is another discussion we will lead to controversially, because I know the opinion of my colleagues at Bookmap, and we have a different, based on our backtesting about icebergs. So there are big differences, but anyway, just we will still, Raimo, we will still be friends. Be sure.
Yes, I know.
Yes, I know. And one last thing I would like to add, and the rest I think will come back later on. But of course, also there are easy days and there are difficult days. Sometimes you only see liquidity above or only liquidity below, and then you know the way it's highly probably will go to. And some days you see liquidity all over the place, and then that's a hard day to trade.
Absolutely.
So,
So go, just for your information, for your documentation, and when you're coming back, if you don't know what means LTHL, STHL, it's long-term high liquidity and short-term high liquidity, and so on. Just keep it in mind and refer to the documentation. I would like to come to the liquidity tracker, because it's the heart of the trade finder. It's not the iceberg. You know, everyone in this world, on this planet, if he is able to program, can do icebergs or program icebergs. That's really nothing special. You have to have an understanding. There are a lot of papers outside, thesis outside, how to code or how to program icebergs. This is really nothing special. So don't believe that iceberg is really something you should have. But what and therefore I'm stressing that, is that this liquidity, by the way, see this dynamic iceberg development that gives you back few points. We will talk about that. Let me make a screenshot because it's so interesting.
Walter, one more observation I want to discuss on the liquidity before we move to icebergs. Can you go back to the ES again? The big move that occurred. Go to the some more to the right, please. See the at 1600, the liquidity. Keep coming to the right from there. Keep coming to the right, please. And then see there's a drop. See that they were adding, and they added the big patch on the bottom. They added the big. So can we get some clues that the market is kind of going to the downside?
Yes, we can. When you experience, you see that we can. Because, this guy who is playing with this amount of contracts here. Let me just see what was in the book. Therefore, the book is precious. 500 contracts, 537 contracts here. So, just let me just a moment. Let me see. You see this Bookmap introduced this, how it's called, large lot tracker. You see this small vertical line here, 544, and there's small white line. That means this is an order which most probably belongs to a big player. Let him call big player. Let him call him. So here's adding, let's say, 400 contracts here because he is well informed. There are a lot of theses around in the internet. If you have time, read about informed trader. And then he placed, let me say, 400 to 500 contracts here at 46.80, and then the price approached the 80, and then he cancelled. You see this clear cut here, and dropped his order to 78.75. You see that? That's a language, guys. That's really something he wants to tell us. He wants to tell us what really happens in the book right now. That's a language. We must learn this language. We must understand that, as Raimo said, that was liquidity. We don't know when liquidity is coming back. It can go against us. It can go further up into the 90s, and we are still sitting maybe short because we think this is the target. It can go immediately against us for 10, 20 points. It doesn't matter. Those guys who are sitting there and waiting, they have another time frame than we, and they have maybe bigger pockets than we. But this guy here dropped, and that's what you say, Srini. And that's a language. That's something. That's a real-time signal. You remember the first when I mentioned the first paradox of indicators. That's an indicator, but it's a real-time indicator based on the best data we can actually achieve with Rithmic MBO data. That's really amazing, because Raimo, Srini, Levi, whoever here in this room, Bridge, when we understand that, we see, okay, guys, we are sitting here in the room together in the trading room, having fun and watching this, and suddenly that happened, and every one of us individuals here in the room will understand that this is a sign that the market is going to trade against 78.75. And it did. There was as well the gap. I think it was 78, not sure. But I think that was a gap. That was a sweet spot up at this point. So trading up into this liquidity. And then the liquidity remained at 78. So what we should keep in mind is, and I would like to hammer that in your head, is liquidity is the blood of every market, and liquidity is the leader, and every single transaction, every single contract needs liquidity to transact, and that was the outcome. We couldn't say that this is really going so badly down, so fast down, but we have had some indications thanks to your idea, Chris and Raimo and Srini and all of you here.
Hey, Walter, also, I don't know how much you pay attention to the developing point of control, but if you go back to that area, you'll see that it shifted down as well. So
Yeah,
so it shifted down. You know, you're further along. You see the liquidity has dropped. You see the point of controls drop. So it's giving you an indication that it's good chance it's going to head south.
yeah, that was the best chance. I'm telling you what I'm telling. The best chance is these liquidities. They have been there all the time. The question is now, where can we get a sweet spot to enter the market? I mean, I would have been long here because it was a gap. I will show you the price dynamics plot, and that was a good start, as well as here. If you are very short-term trader, you're trying to get some points and ticks out of the market. We'll talk about this price dynamics plot. But then here it became very nasty. So you see that. So the point of control. And by the way, what maybe I forgot to mention is I have the volume profile here as well on my chart. So if you're following volume profile, if you following Dalton and Steidelmeier, and I think the most important one, I would recommend to have a volume profile on the chart as well. That's it's free. It costs you nothing to add a volume profile to your chart to get at least a clue where the point of control of today is. And when you know how to look at the volume profile, it's a normal distribution day, double distribution day, whatever it is, you will get the information on chart, because it's still there. You don't need to spend money for any expensive programs, since you have the only exception when you have Sierra or Ninja or whatever, it's still implemented in the program. Iceberg, Levy, iceberg knots we'll see on dome level. Not sure what you mean. On dome? No. So I suppose you, Levy, I suppose you mean following that we can maybe see the icebergs in the dome here. No, it's at least I don't know. I'm not aware that there's any program we would show icebergs on dome. We will see icebergs on the chart, native icebergs as well as synthetic icebergs. Yeah, that might be. It depends to Chris as well. I would be very cautious. We can't. We will discuss this. We need market by order data to find real icebergs. Otherwise, every other iceberg is a synthetic iceberg. Because when you don't have the information in the order ID, in the data string, this providers delivering or providing to us, you can't find an iceberg. Therefore, Peter Davis is really going against icebergs, because it's hard. You have to have rhythmic data to find native icebergs like here. That's an extremely well iceberg which started here and then got a fill here at 75. We'll talk about this a little bit later.
That's what, Walter. Are you going to cover some basics of icebergs? I got some really confusion.
Okay, we can do that when we come to the icebergs.
Please, yeah.
Yes, liquidity tracker. Let me show you the liquidity tracker, because it's simply a genius tool. No, let me. Liquidity tracker, yes, liquidity tracker here, because what's most important of the liquidity tracker is the relative liquidity, absolute liquidity, and we added the price dynamics plot here into the book, because we talked about the market volume, average liquidity, and the live view. A live view is simply, you can have the live view of ES. You can add the live view of NQ. You can add the live view of SPY. So you can have literally hundreds of live views here on your chart, and then you can see the correlations between SPY, ES, and Q. We can add QQQ.
Nee, ik moet eerder volgen. Je moet eerder volgen.
Oh, if you are, I have to mute you because there comes some sound through. Now you see this is part of liquidity, and you know liquidity and volume is important. Now you see very nicely how SPY behaves, how the ES behaves in correlation to the SPY. You can watch the NQ and QQQ and have an idea when QQQ is leading, then NQ will rise, and vice versa, as well SPY and ES. That's a part of the liquidity tracker. So you can have literally 10s, 20s, or whatever live views on your chart. But what's most important, we talked about that, is that we have relative liquidity and absolute liquidity here in the implemented, because we the TTW trader, TTW team, we think that this information is extremely important because it indicates, let me show you again, we talked about that, when we see this 4690, then we see a relative liquidity is added. Let's have a look at 4690. And therefore, you know, guys, ladies and gentlemen, it's really hard to understand the liquidity concept when you don't have the DOM on your chart. I mean, you can leave the DOM apart or away from your chart. As long as you understand the liquidity concept, you don't need the DOM. But what I just want to demonstrate here at 4690, you see 289, 290 at 4690. Look, watch what happens. 290 at 4690 here, where my cursor is. You see what happens? Bam. This 290 jumped to 390 at 4690. That's a relative liquidity change because 100 contracts have been added to 4690. What does this mean? What does this mean? When yeah, so
price may come there.
Yeah, might be, but that's speculation. But what is the hard fact? What is the hard fact of this hidden liquidity changes when we see that, or when we notice that 4690, 290, and then suddenly it jumps to 390 by this indication? What might be the hard fact? Why I'm stressing that?
You can trust this liquidity. If they're adding, yeah, so you can trust this liquidity. So sooner or later it will be hit, probably.
I understood only you can trust this liquidity, and what else?
Yeah, no, nothing more. You can trust it. It's not
Yes,
going to be
T1. Ask liquidity added.
Yeah, so that means following. When you look at a book, you see all these signals. And that means that the big players, or let me say whoever is playing that, adding liquidity is does not happen by chance. All this stuff here is intentional. When you see one, as an example, 100 here, and then what happens here? He cancelled 50. There's still some liquidity here, which is at the moment, what it is, 350, but he cancelled that. This is something what this guy is telling us, what this guy is going to tell us. You know, when we are trading that and trading here and we see 100 coming up, that might be a sign that the market will go back here to this, or might trade into 46.90, and we see as well 300 here. But what happened is simply that the market broke down for some reasons. I don't know. We don't know at the moment. And then he cancelled as well. He cancelled here and here. This is a language of the market which we should know. It will give us more information than not. So what I'm watching is changes more than 100, but just for the purposes of demonstration here, I set a liquidity tracker to 50. And when you are using TradeFinder, you set a liquidity tracker to 50 or 60 or 100. Then watch for the changes in the DOM which are away 20 ticks. That means 5 points from the best bid offer. 80 means 20 points from the best bid offer. That means TradeFinder liquidity tracker is tracking all the liquidity up and down. To the upside, 20 points to the upside and 20 points to the downside. And then that's the point. That's simply the amazing point. You will see all this liquidities comes up and will signalize you, okay, there's one guy who is playing with the liquidity here. He wants to be traded maybe here. If not, he is canceling, he is layering, he is adding to different liquidities. And that gives you a clue what they are trying to do. Like here, green means on bid. Green means on bid, and that's simply support. That means if they are coming down, they most likely are supporting that. You see they're adding here and then canceling here. This is a language. This is a language you can use with a liquidity tracker, as well as the absolute liquidity is a little bit different. It's a little bit different, as we talked about right here. Yeah, that was the example here. Excellent example. Again, you have to have the DOM here. But when you see this, you know, the problem with trading, when you are staring at a chart, when you are looking, then you have the Bookmap maybe open, and here you have your NinjaTrader open, your NinjaTrader chart, 10 minutes, 60 minutes, 5 minutes, 1 minute, whatever chart you have. Then you're watching on the NinjaTrader or Sierra chart, it doesn't matter. You're watching your normal normal chart, and then you have Bookmap on. It is so overwhelming. All this information is so overwhelming, so too much to watch, too much to be focused. And that leads simply maybe to overtrading or whatever. And you are missing all the signals because no one will tell you that this is really something important. And the absolute liquidity here happens really very fast. Maybe his intention was to trade 84.50, but then he jumped to 84 even. Maybe this is the same guy here who traded 84.50 and then lowered the liquidity at 84 even here, 84 even. And then suddenly he cancelled here. By the way, the point is valid. just to save plus and minus here as well. These are absolutely changes because the absolute change was 1000.
Walter, just why he would have cancelled that? He placed it.
Yeah.
You know,
Yeah.
I'm just.
I don't know.
What was
I
the
don't know.
reason?
I don't know. I don't know.
Sorry,
Yeah.
can you hear me?
Yeah.
If you go back, then you can see really clearly why, because he was accumulating the long positions there. You can see like it's a kind of a spoofing. If you make it a little bigger, you can see underneath there the yellow one under 652. There's like really you see the 652 orders. You see 1044.
Yeah.
Zoom in there like you see the yellow one
here,
on
yeah.
the ask side.
Mhm.
Exactly. That's why.
Good point.
So what's that? I'm sorry, I didn't get it. Sorry. So yellow one. So
Argo, can you repeat it, please?
you.
Hello?
So yeah, the intention there might be like he was accumulating the longs there and or wanted to get like out of the position. There's two options, and he was wanted to get the price, and that's why he was holding on the price there. That's why.
What Srini, I think he's saying that he is trying to accumulate here at 83.50, right, Argo?
Yes, or get the shorts on or whatever the intention was there, but he wanted to get the, like at the price and the whole price up there, and that's why it was this action there, like with this limit orders.
Okay. Yeah, can be. I can't comment that. So it might be. This might be. You're saying that he is accumulating, then simply lifting, trying to keep the price lower, 84, and then he wants. I understand. Maybe he wants to accumulate here at lower prices to trade him higher.
Yeah, correct. That was my.
Okay. I see what you mean. I see what you mean. So your idea is to saying, okay, based on this liquidity, this guy who wants he wanted to have lower prices to accumulate, then he is blocking the upside here at 84 even, and then simply he got what he wanted. Maybe he got what he wanted. I don't see that, but anyway, just to have the idea, and then they are traded into 84.50 here.
So he wanted to
Yes,
buy
yes.
at that 82. So he kept the market down.
He put a lid
that
on the
way.
pot here and trying to get lower prices to accumulate and then trade higher. That might be a reason for that, but yes, that might be a reason for that. So good point. Here and here, yeah. Okay, where have we been here? And by the way, the next point for those of you who need more signs what the market is doing. When the market trades into resistance or support, like here, let me take this one. Then maybe Raimos, do you have here some signals here or whatever on the SI tracker? I'm not sure, but when the price trades into an,
Let me check. Yeah. Let me check.
into 67 in this case, then we introduce the price dynamics plot. The price dynamics plot is simply based on the aggressors and the liquidity. This is what we see here, what they are selling into bids and what they are buying from ask. We have visualized, we're trying to visualize this behavior because it is extremely hard to follow these numbers here. It's important to watch it and to see what happens under certain liquidity levels. But our intention was, how can we bring this technique of the order book, not based on numbers or whatever, but in a visual style to give you a guidance to show you in a blink, in a moment, what the market is doing. We call that price dynamics plot. And you see in this example right here, you see this big red sign here, bullet. This is, yeah, the intensive the color is, the intensive the color is, the more volume was traded at this point. That means this dark red bullet means that this is a high volume traded into this level. And when you zoom in, so we are sampling, because that's how we are relying on Bookmap. That's really hard to code and to make it visible. We are sampling. We just optimize the price dynamics plot to the futures, especially for the ES future. You see how more and more sellers are hitting the bids, and suddenly they are accumulated here into the liquidity. We got a big red dot here, which means high traded volume. And then you see immediately that buyers came in control here. So that means this price dynamics is showing us, in this case, at that extreme point, that was an exhaustion of sellers. And now the buyers come back into the game and trying to lift the offer. Green, dark, no, it's not dark green, but light green, light red, because sellers came back, but really minor one. The force was not big here. The intention was not big. Then finally the buyers take control and the price goes up. Due to the nature of the game between buyers and sellers, it's impossible to make everything green, because this is a real-time indicator here. It gives you an idea that you can't short here, but you have to go long. It gives you an idea that this red bullet here, in this case, is a high traded volume, and it's not a spike, because when you, and that's the point I would encourage every one of you, if someone from Bookmap is telling you that's a spike or that's a stop run or whatever, zoom simply in and see what happens, because the aggregated data in Bookmap gives you a completely different view of the market than in comparison when you zoom into the market.
Other. Some interesting thing I saw on ES. If you look at the screenshot that I shared, you see that the first one is indicative of a stop run, but it's a small one, as you can see. But if you look at the chart, and that's the second screenshot, that's some interesting stuff. There you see that this is a stop run for the low of the previous day around 9 o'clock.
Yeah, I see that.
That's the blue line. So they went for the stops just below this one. And when these things happen, it tends to be a sharp turn in a lot of cases, because it's a stop run where they shake out all the retailers, and then they go up and they sell it higher.
You see the stop run if you want here, but
it's especially interesting if you look at the chart, because it's very obvious.
I see what you mean.
They went a little bit below it just to take out the stops, and then they make a run for it.
By the way, you see that this is the same line here. I know what you're saying here. I'm really... Yeah, I don't want to discuss this right now. You see that this is MVB.
No.
I doubt...
But I find the chart more interesting at this moment.
Yeah.
Because you just see that they go one tick, a few ticks below low of the previous day, 9 o'clock, and well, then they make the big run, the relatively big run, and that's what they do all the time.
Yes. The question here is, I don't know. I don't want to argue here with the stop run. I'm very cautious with this stuff here. But anyway, I know that they are telling this is a stop run. You are looking at the 46.66 here. What is this? 46.50. Let me see it here. 60.50. There was a drop down. There was another drop down with a high volume. Yeah, it might be. So let it be. That's okay. We're with this volume spike. Let me see if we can find a volume spike for that, because it takes time. It takes 80.22 and 80.22 maybe 10 seconds or 41, which means 41 here. 22.30 and 40, that means 10 seconds. Let's see if we can find it. Excuse me, that's the wrong one. I'm just watching for the big spikes here. Let me see if we can catch that one. Price range was as well small, 68.50 to 67. Let me just find 4 ticks. But more than that, I wouldn't ever. Okay, anyway, I would suggest to watch for this exhaustion, because that you'll see here, sell volume spike. You can drill down the numbers. So for every single of this spike signals, we call it SPY signals, because we use them as well for stocks. So what I have, a trigger volume of 300, maximum duration 1 second, and then price range at least 4 ticks, and the ratio between buy and sellers is 2. And that means we got a signal here as well. We call it spike signal because it spiked down. Whether this is stop run or not, that's something different. But what we see here is as well, we see the spike. We have this indication in the price dynamics plot, which shows exhaustion because of the high volume. It traded not exactly in the, maybe in the liquidity here. And then the price dynamics started to show green. And you can rely on that, at least for the AES E-mini future. You can rely on that. So that was a spike. The question is, what should we do now? Go short or go long, because we don't have anything here. And the price dynamics is showing we have to go green. There's a small pullback. We have to go green here. And then we have to manage our trade into 74. This is extremely helpful indication here, because when we see the volume spikes into a certain area, as well on the MVP, you see the same one. By the way, Raimo, this is coded by Sergey from our MVP, or my MVP is coded by Sergey from Bookmap. And it shows you the spike down here. You follow the price dynamics. Price dynamics show you the real order book trading we would like to see when either the buyers are in control or the sellers are in control.
Walter, in price dynamics, it shows the aggressors or the interaction of the aggressors with the
interaction between aggressors and liquidity.
It's an interaction.
Yeah, it's not.
So it's not like it is not like all much aggressive.
No.
It is the.
It is the interaction between aggressors and and liquidity. That's the purpose of this green band of the price dynamics plot, because my philosophy is that we should maintain a clear picture of the market. And Raimo has here stop runs based on the SE tracker. We have the volume spikes because it took several seconds to trade into this level, into this liquidity level. And then the question is, what happens next? All this, the price dynamics is a kind of exhaustion. It shows you very clear. This is this you can. Let me show you that you can play with different settings here. You can separate them so you see better maybe what happens, and you start to see that there are more buyers than sellers. You bias the sellers, so the transaction on the bid is higher, and they are supporting the price up than the sellers. There is nothing. You see white, a little bit red, white, white, red, white, but you see how dominant buyers are here, how dominant they are. You can combine them to put them together, or you can separate them, and you will see very nicely that they are leading. So given you are long 68, then we come into the next liquidity here, and then the price dynamics plot starts to show there are more sellers, there's more resistance here. There's more resistance, there's more resistance. There are not enough buyers at this moment. That can change, because this is a dynamic order flow that can change. But see what happens here. Exhaustion, and every exhaustion, that was an iceberg of 3,000 here. That was a 3,000 iceberg at 75. It was it was long in the book. Yeah, of course, that was this dynamic iceberg development. Nothing was left. Everything was traded. 3,000 have been traded here. And what happens when the price exhausts? What happens? The price takes a break. It needs more buyer. Or the exhaustion is here. That's the first one. And the second one is here. So the price is, then you see there are more sellers than buyers, there are more sellers than buyers, and then they are trying to keep the price down. It's a fight anyway, it goes up, and then they are starting to sell it again here because it's red, more reddish than greenish, let me say that way. That's liquidity, ladies and gentlemen. That we are talking about resting liquidity on the bid, on the ask, and we are talking about market liquidity. That's what happens really here in this on the pit. We are not aware of, or maybe not aware of, because we don't see all these actions here. Exhaustion, then it turns, when you see white and green, you have to go green. When you say red and white, you have to go you have to sell, you have to buy. Although you must be aware that's not a tool you can use every day. But you can try it with micros, it works very fine. For the yes, I'm talking about the yes future. We have some slightly problems with, not problems, issues with stocks, and as well cryptos as well. Yeah, that's liquidity. That's volume and liquidity, guys. And you can have this help us just to determine the direction of the market. Still more selling than buying here. But anyway, as we discussed here, at that point we have had a nice volume spike into liquidity, indicated by the MVP as well as the trade finder here. And then it started to go green. There are no sellers here, so we have to take it long, 68. And the next level is 75. We will see in the correlated market how this turns out in the next days, or maybe tomorrow, hopefully. Any questions so far?
One last. So, can you go back to the chart, please? The V delta on the bottom. That's the pure aggressor.
Yes.
Right.
Yes.
Okay.
this what the V delta, or the market volume pro as we call it, are measuring simply the aggressors here, not the interaction between aggressors and resting liquidity. That's what we are not doing here. But it shows, and as said, that what Rhino is showing on the stop run file, it's the same as Rhino has on the stop run indicator from SE Tracker here. It's really there are hardly any big differences here because it's coded the same way. So if you think this is a stop run here into, then you see that was an iceberg 3000 traded as well here at this volume spike here we see here. There are, I don't know where, maybe some fine differences, but it's not really not much, because when you overlay or offset these two curves, you will see they are really similar. Good. Yeah, we talked about the liquidity meter. I just want to go again here. Why is it important? Because the volume and liquidity meter, you will at any time knows when and why a market stalls. There are no aggressors. So for our trading, it is important to understand that when there are no aggressors, there is no power, there is no energy to move a market into a certain direction. And when we see a high market volume participation, we must be ready. We must be ready to fasten our seat belts, of course, because the market will trade very fast in one direction. So either it goes 90-degree up, which means sweeps or high volume participation, or it takes some time. And that's what I'm saying. The market volume is extremely important to us, and as well the resting liquidity as well is extremely important to understand the characteristics of every single market. When we trade stocks, coming back to Tesla here, if it opens, then we want to find the spikes. We want to spy the sweet stops or the sweet entries here. When we trade Tesla, we want to know where the liquidity is. We want to, maybe we are late and we want to catch this the swing highs or swing lows. Depends on. That's what we want. And to understand if the market is really in the mood to trade, I think we saw market volume of 50,000 or something like that. I can't remember even when we have a previous 15,000 here, when we have had a previous look. So that means that might be the average liquidity, market volume for Tesla right now. Not sure, but you will see 50,000 here for this. Let me see Microsoft. Oh yeah, that was another point. 1,200, and the average liquidity of Microsoft is 250 here. So every single instrument you are working with will have his own characteristics, and this own characteristics, I think, should be considered when you are trading a market. And I'm not a friend. I'm not a friend to see everywhere some numbers, but I'm a friend to watch this, to find the sweet spots, and then to trade. I want to be the first on the yes, or in the saddle when the market lifts off or starts to trade. And by the way, guys, few minutes ago I told you, or I mentioned that the market, that this price dynamics plot is more reddish than greenish here. So it's really hard for the price at the moment to trade higher. It's still more sellings than buyings. For those of you who are scalping, that might be an idea how to do. Okay. Yeah, we talked about the live view, which is quite important to see the correlations between markets like QQQ, NQ, ES, VXX we will talk about, and SPY. Okay guys, the price dynamics, I talked already about price dynamics. I would like to encourage you to have a look at page 27 and 28. As I mentioned, the price is always driven by market buyers and market sellers. And the price dynamics shows you very reliably for the years. I'm not talking about stocks, I'm not talking about cryptos. Please be aware of that, because we are just examining and researching and understanding how to code that best for Bookmap. You know, it wouldn't be a problem, it wouldn't be an issue or a challenge. No, it wouldn't be a challenge to do this for NinjaTrader or Sierra, but in Bookmap it's a little bit more special. And therefore we are sampling the buyers and the sellers in the transaction between aggressors and limits. And then we are drawing, or how to colorizing or plotting this information in a plot. You can separate or you can combine, and then you get a very nice overview what the market might do. And this spikes, this greenish and reddish spikes here, shows you exhaustion. You might see, based on what you are using, what indicators you are using, you might see a stop run or whatever, a volume spike. But you see that as well here in this diamonds or these spikes here in this case here. Yeah, price dynamics is primarily developed for the ES future. It works with most liquid futures. It is not tested with stocks and cryptos. As I mentioned, it is an easy visual guidance for buyers who lead the market at any given time. It's unbelievable, guys. I'm not sure if you are using that. I would encourage you to watch it simply on the ES, and you will see that you will get the best information out of the market without having your eyes on the dome. So easy visual guidance, who lead the market in any given time, buyers, sellers, or it is a choppy order flow. Yes, indicates the actual market condition, buying or selling or sideways. And it is a reliable real-time indicator to determine or to judge the art of order flow at any time for a trading day. This is really helpful to see live right now here. How they are fighting with this area. More sellers came in, and then the buyers lifted back. Let me know, where is it here? Sorry, I'm wrong here. Maybe I like the combined view because it's constructed to show you who leads more, the sellers or the buyers. So you see that very nicely here into this liquidity above. Good. Any questions so far?
On a thin markets, Walter, that dynamics is like NQ. It doesn't do that good job.
Yeah,
I noticed.
That could be so. Treat it. I would say use it for the ES future. Right now, we are just doing a research because it depends on this dynamic price dynamics. Yes, you are right. Srini is sampling the trades, and the less liquid the market is, the more hard will be to follow this price dynamics. So I'm using it for the ES at the moment, and we are discussing how to develop it for the thin liquid instruments as well, for the stocks. That's really an issue, and I must say use it for the ES. And be very cautious with cryptos and stocks with that. And as well, I never traded it with NQ. That's what I'm not trading in Q, so I don't know. But if you say that, that's okay. That's great. Hidden liquidity changes. We talked about that. We saw several examples about absolute and relative liquidity changes. Let me skip that because oh no, that's simply something interesting here. Yeah, that's why are we doing this effort? Why do we do that? As I mentioned, that's a screenshot of last Friday here. You see here on my chart. We want to know where the game players are in the game. On some days it's crystal clear. Excuse me. On some days, it's crystal clear what the market is doing. Excuse me. On some days, it's crystal clear what the market is doing. I will cut this out. So again, on some days, it's crystal clear what the market is doing. Because liquidity is always there to manipulate the price in one direction. We can see hidden liquidity changes. We can see who is playing at what price levels he is playing. He's playing that. And that's of extremely it's an important, worthwhile and meaningful information to see that. You see that how the lifted the liquidity changes up into the 49 or the 46. I don't see that 46. So 1, 2, 3, 4, and so on here. It will give you a clue that there is a significant player in the market. As well, you will see how they're canceling, adding, canceling, adding, canceling, adding, canceling, adding. And you see all the way up what happens. This was the last Friday, by the way. This is nothing which happens without any intention. Although we don't know the intention of this market, and at every single second. We don't know that. We can't know that. We can't predict or anything. No, why is that happening? Because we don't have the information. We are not well informed. Maybe he is awaiting on news or on speech or whatever. And that's what tells us how the market behaves. And when you see the overall picture, you see how the market is trading down, and they are simply lifting the liquidity here, adding. I think at last Friday, someone said, I think it was in our room, that the price is going to trade at that point here. Time is going to trade into 80, 85. That was the outcome. It's simply based on this information here. Okay, guys. What do you think, making a break until tomorrow?
Hey, Walter, this is Frank. Hey, Walter, this is Frank again. On your volume spike settings, I was trying to duplicate the sweep, the volume spike that you had on that one at 67. That'd be probably 12.
22?
22. Yeah, 12:22 Eastern. So that sell spike right there, that volume spike. What's did you change it to get that? Because I was looking to see.
I didn't change the sweep because this is not a sweep. I did change. I did
Yeah,
the
the
volume
volume
spike.
spike.
300, 1, 4.
1, 2.
You
Interesting. I can't get
Really?
that one to show up. Yeah.
And the other thing I was going to ask.
And the other thing I was going to ask you is that if you go over to when it first came down to that 67 level earlier,
just give me you don't see this volume spike. That's really strange. That you should. What you can do following. Try following. Put a ratio to 1 and put a trigger volume to 200, and then you can
See if that gets it.
see if that gets
yeah.
it.
So 201.
So 201.41.
It must be there.
It's going through and calculating.
It's going through and calculating.
It must be there. It might be that the data feed and the data quality differs. That we have slight differences, but it must be there. There's no excuse. You are running version 3 as well?
Yes.
Yes.
It must be there.
As soon as it gets finished calculating.
As soon as it gets finished calculating,
For some reason.
for some reason it is not showing up.
Weird.
That's really weird because we should have the same signals. We should have the same signals, and I don't. You are running. Are you running
I have
Rhythmic as well? Right? Yeah. You are running.
Yeah.
Can you make us screenshots here based on the ES and the configuration here? So just send me that over. It must be there. It must be there. No, wait. What you can do, increase the duration to, let me say, 5 seconds.
Okay. Try that. And the other part I was going to ask you about is on the price dynamics line. If you go back over to earlier in the morning, when we got the first spike down to 67. So more a little bit later in the morning there. So right in there. So
I just wanted to
see on the price dynamics. Okay, good, because you're showing on your price dynamics.
Just a moment. I just want to get rid of this numbers here. Someone is.
I got it that time.
You got it?
Walter.
It's time. I think then it's time. Maybe you have to adjust it to 2 seconds and you will get a spike here. I don't know why that happens, but it might be the differences in data feed somehow. So that's here. Are you talking about this one here?
Right. I was just trying to see.
Right. I was just trying to see on the price dynamics the brightness of the line or the cell was much earlier versus when it hit down here at 67. It wasn't as bright as price came down. The selling wasn't as exhaustive. You know, over there at what 1745 on your chart.
Here.
Yeah, right there. Yeah.
Yeah, right there. Yeah. So the price dynamics wasn't as bright and as big
as it was.
And I just wanted to confirm and make sure that mine's picking it up the same way yours is picking it up.
You can even, if you're a little bit familiar with this kind of indications here, although it's as I mentioned, it's a challenge. You can even spot a divergence here because that was heavy selling here. That was really heavy selling, then having heavy buying here. So and that was a little bit of mislead here, I must admit here. But it was very heavy selling, And when it comes to a break, because we don't know at that moment that if this is a low or if this is not a low, you have to disregard the rest here of the chart. But at that moment, we don't know if this is a low. So it's not a best advice to jump in here, but wait until this price dynamics. If you rely on that as well, you have the V delta. You have this. I think the stop run line with SI tracker is very similar. So it shows an divergence here as well, and you can see spot even the divergence here because that was high volume, heavier, higher volume. Then it is here higher volume. So you see a very nice divergence. And if you don't want to jump in at the low here because there's a divergence between those 2 points, then wait until it turns green, and that gives you an additional idea that they are just buying from ask here and they are hitting. No, they're buying from ask and lifting the offer here. So because we have the divergence at those 2 points, the market goes up and it's signalizing, okay, buyers came in here or started to came in here. And the next level is the liquidity level at 47, 73 and 74.
Got it. Good. Thank you.
Not at all. Karen, you should. I think it's as I mentioned. What was it? Let me see. Where was this volume spike? Where was it? I think it was here, wasn't it? Karen, please. No, please. Well, excuse me.
I think it was at 10:22.
Yeah, you should try it with maximum. Increase the time. Increase the time to 5 seconds, and you should have it then. You should have it. You should get it.
The 5 seconds.
I think it's a matter of time. It's not a matter of volume, but a matter of time. I don't know why, because that might be because of the delays or whatever might happen in the market. But you should find it when you should have, first of all, the same signal. The only differences might be in the time. I have...
That's maximum. And that's maximum.
Yes, maximum duration. Put it to 2-3 seconds, then it should appear as I have it here. Quite sure.
Okay, thank you.
Okay, thank you. By the way, guys, before I would say let's digest and let's see what's in front of us and then continue tomorrow. But what's here? What happens here, guys? Based on the relative liquidity in the book. And how is that informative for us?
May go down.
It may go down.
Yeah, it certainly looks like it's.
Yeah, it certainly looks like it's being. They're wanting to take it down to 46.65.
But I would think you would have.
To get a shift.
With some
other, I guess, some of the other liquidity down to kind of get it down there.
Yeah. You know, as I mentioned before, this is a language. What we see here is a language, and we should understand this language of market language, because suddenly something happens. So we see 65 came up. First of all, interesting is that this guy put the liquidity. Look here, put the liquidity at 66, and then they're lowering this 65. Look here, that's real time, guys. And as we are talking about this liquidity, we see a huge sweep. We will talk about sweep.
There's the shift down in liquidity.
And by the way, mind following. There was a shift down, not much, but anyway, it was one. And then when this happens here, you see what happens to the liquidity at 65. It was added on both sides. So we have 65, and let me just 65, because Bookmap aggregates data. Please keep always in mind, don't trust Bookmap, it aggregates data. 65, and they added liquidity above 65 and below 65 a little bit. You see this is orange, dark red and yellow line here. And you remember we talked about that maybe here. The price dynamics turned red, and that was a fair assumption, that was a fair conclusion that the price might trade into the 65. So they're canceling at 80, and the next target could be and might be the 65 target, which is an institutional level 63 as well. That might lead to a trade into 65, then 63 as well. Can you point TradeFinder liquidity meter is different than BM Global and liquidity meters? What is liquidity meter Bookmap? I'm not sure.
I mean the book, the volume. You have a Global Plus license, right? So and on top of, but right next to the book,
that's order book imbalances. These are order book imbalances. So these are order book imbalances. This is not a liquidity meter, they call it, but they are showing order book imbalances. We will talk about tomorrow. We will talk of order book imbalances tomorrow. But that this is not a liquidity meter in the sense of a liquidity. It simply shows
the balance, the order book
imbalance.
Okay,
Okay, guys. How should we proceed? Do you have some time? Should we add another hour this afternoon, your time, US time, this evening here in Europe, to discuss the order book imbalances?
I don't know, Walter. It's 7:30 in the evening, my time. And I have 5 daughters, so I'm okay with another half an hour, but an hour might be a bit overextended.
Tomorrow is fine as well. I know it's overwhelming information. I have to go in. I have to go into myself and. No, let's do for the next minutes, and we can. No, I have skipped that one. So sorry. I think we discussed the most important parts. But just let me add for the next few minutes something you may think about what's in for you tomorrow, and then let's continue tomorrow with the icebergs, and let's come to the strategies. What I recommend. I can talk all the week about this interesting indications pieces of the market, but it's really something it's too much for everyone today. Yes, great strategies are important. We can do a recap, but very briefly, you can please go through this information. Order book imbalances. Besides the liquidity, just one sentence. Besides the liquidity, the order book imbalances are important as well. Because the price seeks liquidity and the price looks for order book imbalances in the book. Where is the highest liquidity located? And if you're on with NinjaTrader and other charting programs, you will have order book imbalance indicators as well included in, for example, NinjaTrader. The meaning of the order book imbalance is that it shows us where the biggest imbalance is. I mean, I mean, what I'm saying by that is that we see where the imbalance is or might be in the book. But in some, I don't find, let me see if I find anything. Yeah. Oh, no. If I find something today, if I find so, no. So the trade finder is measuring the order book imbalance. It shows you with an triangle where the market might trade to or going to, but I don't see anything really meaningful right now. Let me see the NQ. Yes, here, for example. In this case, although it's really, I would be very cautious with thin instruments. You see this triangle with this 30. That means to the upside on the ask, based on this liquidity, there is more pressure to the ask side. There's more pressure to the ask side because the market seeks liquidity, and that's extremely important to you, to know for you, for everyone. Market seeks liquidity. Look here, this is another liquidity tracker, imbalance tracker, who points to the downside. On the downside, there is more liquidity than on the upside, as well here. So that means the imbalances in the book are extremely important to understand where the market might trade to. On your slide, you have an example that is based on last week, don't know, Thursday or whatever. You see what happens here. This is a perfect trade. That's the sweet spot. If you are patient enough to understand and to find these sweet spots, you will be rewarded immediately with an extreme risk-reward ratio first, and then maybe an outcome which gives you 10-15 points back. That's an extremely nice picture here. That was, I think it was last week, I think Wednesday or Thursday, I don't know. And that was the pre-market. The pre-market traded into liquidity. Then the imbalance tracker came up and signalized, oh, wait, there's to the upside, there's more liquidity. Although, I mean, that's really nothing magical because we see that already here at this level. And in the price dynamics plot, you see only buyings. Then the pullback came back here. But when you are entering the market at the lowest possible point, you will understand that the market is or will trade towards this liquidity. That's what I calling a sweet spot. And the imbalance tracker, don't ignore it. Put it on if you are trading ES. It's much harder to have them on chart if you are looking for QQQ or SPY. I will show you that, because it is extremely hard to find nice liquidity edges in SPY, in QQQ as well, and therefore the liquidity tracker is meaningless in this kind of environment. But for some nice high liquid markets like ES, we can use it as well for the treasuries. So the order book imbalance is important because it points to the side where the biggest or the most liquidity is. And as mentioned, the liquidity is a attractor, repellent, or supporter. It can support the price, it can attract the price, but be as well as act as repellents, be repellent to the price. As at liquidity levels, institutions, market makers, algos are seeking to transact. And icebergs are used to provide liquidity along the auction, not necessarily at swing highs and swing lows. One last point for today I will stress is, if you don't see liquidity, that's as well important as well. So we have two clusters in a chart normally. There where liquidity is and there where no liquidity is, and that's important as well. Okay, guys, that's it for today's. Tomorrow we will talk about sweeps, stop runs, volume spikes, and absorption, and then we are starting with the strategies. It gets more exciting to talk about icebergs and sweeps tomorrow. We'll get a little bit more dive into this structure of those sweeps and icebergs, and to discuss the icebergs, and then we will go to the options, and finally taking all this together into the strategies, the correlated markets, which is where you will see extremely important to know. I will show you what maybe you haven't seen before with the correlated markets, and we will take them as a main argument for us when we see what happens and how to trade. To wrap up, yes, I'm going to stop the recording, and I have to not transact, but I have to make an MP4 file, and then I'm uploading it. You will get the link tomorrow for the recording. To wrap up, we should gain.
Walter, but can I ask one question? It's about the slide before. That's one of the big mysteries for me using Bookmap, where there's this zone where there's no liquidity, and yes, this one, and this is one of the most fascinating things for me, because I understand the idea of that liquidity is a big magnet, but I can't tell exactly when liquidity acts as a magnet or when it works as a deterrent, because in some cases it approaches the liquidity, and then just before it hits the zone, it goes into the big black zone, like the no liquidity cluster. And this makes no sense, because the liquidity is then in this example below, and above there's no liquidity at all. So what is the phenomenon that explains this situation, and do you have anything that might shed a light on this?
You mean because you are not sure that let me just repeat, I'm not sure if I understood you right. So that it's hard to understand when the liquidity the price is attracted by the liquidity as a magnet, and trades into liquidity, and there is no liquidity above or below.
Yes, and sometimes it just goes on and it eats the liquidity, and then it makes it move. Yeah, of course we can understand this all, because the liquidity has been eaten up then. But for example, in the screenshot that you have in front of you right now, in a lot of cases, it just before it reaches the liquidity, it goes straight up and goes into the black zone where there's no liquidity at all, and that doesn't make sense, because there's nothing to gain there, because there's no liquidity. So why doesn't it go through then? And that's one of the big mysteries for me.
Do you understand what I mean? I understand very well what you mean. I don't have a right answer right now. I don't have the right answer right now. I understand what you mean. I mean, it could be, the first thought I had when you asked that was that it is when the market trades into liquidity here, and it could be a kind of short squeeze. Let me see, short squeeze or taking profits here. It depends on. I mean, this is a little bit of the wrong picture. Maybe we will see the right pictures the next days here, or maybe another picture where we can come back to. But when that happens into liquidity, it is profit taking. Let's say it's profit taking. What happens? The price goes down into this liquidity area. Some of them see, a lot of traders, I suppose, see this liquidity area. They are saying, okay, that's my target. And by the way, I'm act the same way and say, okay, I'm taking my profits here. Then some are, yes, some of the traders might see that the price is not coming back, and they jump on and try and drive the prices up. But there's no liquidity anymore, so there's nothing. Most of the, I bet, I'm not sure, but I bet. Let's see if we can find an example the next days here. I don't see any example. Let me see here.
Walter, can I give it a try? Most likely, we have aggressors, not enough liquidity there. So that means price. There was a that means there was a level where aggressors were able to go and get a fill to the upside, even though there is no liquidity there. That means you can see it, I think the indication on the liquidity chart would be you will see very less amount of aggressors.
Yeah, what I would like, Reimer, I don't have the perfect answer for you right now on that. I would like to see that in real time and real life on the chart to understand a little bit better the action. Because this is a really picture book. Let me say that's a picture book, order book imbalance, because there is nothing above, so they are trading all down. But that can change, because they are trying to hit this level here and then get a fill. It is an accumulation at this point. You can see, as you showed in the chart, maybe 2 days ago that was a low as well, or yesterday's low, whatever, and they accumulate it, and they start to lift the price or up, to lift the price up. And that means if they are starting to lift the price up, you will see liquidity comes up here and here and here and here. So suddenly this dark area or this black area here becomes more reddish or
correct.
Because they are seeing, okay, that's the bottom. And that's the bottom. So they're accumulating. It takes maybe 20 minutes or 10 minutes, 20 minutes. Then they're accumulating, and then they're trading back into this dark area. Then you see suddenly liquidity comes up. I don't believe, I'm just asking myself, I don't believe they are just immediately go up there, because we have a liquidity as an which acts repellent. So they're putting the lid on the pot here. You see this very, very small.
Yes, I know.
So they want to trade,
I know.
They want to trade lower. So that's the indication they are not going immediately into what is the VWAP or whatever area, no liquidity cluster area. They need time. Maybe they want to transact, but I can't remember. Maybe I don't have the perfect answer for you, because I don't believe that they are just leaving this area. I mean, it can happen. They are just breaking through this liquidity area.
No. In this case, there is a line of liquidity above the current price, but there are also situations where there is only black matter above the price. And those situations those I'm referring to.
I don't have. I don't have
the
right answer right now. Let's see whether we can spot something tomorrow, Wednesday or Thursday, and we can take it as a discussion base for your question here.
That would be called flipping the book now.
Sorry?
Walter? That would be called flipping the book.
It's calling flipping the book, but we have to see that first. So I don't, Yves and Reimer, I don't have the right answer right now. So let's see if we can spot something the next 2 days or 3 days, and then let's start to discuss it again. Okay. Just
good.
for the conclusion. The conclusion today, we learned a lot about liquidity, and that's the main part. You see how this is really flipping. TradeFinder is, from my point of view, the best tool you can see a spot on the chart what's really happening here. You see how this sweep happened, and now they are attracting 65 here. That's the next attraction point. Order book imbalances are important for liquid instruments. I'm talking about liquid instruments. For other instruments, it's not relevant because it's meaningless. For example, when you look the the QQQ, I think it's QQQ. Yeah, you see that. That's it works, but you see this really tight band here, really tight band around this price action. It works, but it's not perfect. That's really something I just have on my chart here. I'm relying on other significant areas where I can spot the swing highs. That's something with imbalances which are not suitable for instruments where you don't have a very clear picture of instruments here, like the HYG as well. No. So yes, thank you for the first day. It's demanding. I know. We will talk tomorrow about sweeps, about icebergs, and we will come to options, and then starting off to the strategies, and then seeing that we see the strategies running and in action on Wednesday and Thursday, and to discuss all open questions you might have here during the day. Let me go through the questions. Pattern. If you hit a wall of 10,000 lots, I would assume that would pattern. That the point is what you are talking about. You are talking about ES, or you are talking about a stock. Okay, because 10,000. When we see 10,000 here, we will talk about that. I changed my numbers as well here. When we have
Walter, I was just using that as an example. Where the person made the point that sometimes liquidity acts as a magnet, and sometimes it attracts and sometimes it repulses. And I was just using the 10,000 lots as an example of an enormous wall that I would, if I ever saw something like that, I would expect it to repulse. Earlier today, I think there was an iceberg of like 2,000 lots that repulsed for a while.
We'll talk about a very fascinating pattern, guys. I call it business done. That's so fascinating. It works. I would say even 80% of all time, and maybe we see something like that here, which is really repellent, and we'll call it a business done, because they are trying to protect here, or to not protect, but to resist. Then they are off because the price fell down. The price is coming back. They are trying to resist again. Yeah, 10,000 might be a big number, but in pattern I have seen 10,000s of contracts here on the resistance of one side. And if they're in fury, then they are simply taking all 10,000. So that's never a guarantee. But the more red we see, the more they are repellent to this level, the more the price, the less buyers they find to go through this level and eat every single order from the ask here. They are not eating they can, because there are no buyers. And we can, by the way, we can see this repellence of the markets when we see a big volume traded here. Let me say that was a big volume here, and then they are simply running out of steam, and that makes the market more vulnerable to the downside. Maybe they're trading to 65 and coming back here, but 10,000, yes. That could be. I don't know whether I see, but 2,000, 3,000, 4,000, they have been taken out as well during the last month when you watch this day in and day out. So that it could happen. I mean, you have to see an Apple. I don't know whether I have Apple here. Let me say, I don't have Apple here. you need 200,000 to consider that a really good resistance for shares like Apple. We will have enough time, hopefully, to go through all these fine details. I just wanted to make sure that we are on the same boat. We are on the same level with the knowledge when we are talking about liquidity, tomorrow when we are talking about sweeps and volume spikes, and when we are talking about icebergs. That's what we should have the same understanding, and that would be very, very beneficial for all of us to understand what to speak the same language, and then to watch the market from the hopefully very similar perspective to understand what the market is doing. But for today, I think we did a lot of this stuff. I think you are overwhelmed to a certain extent. I would like to say, digest the information. Let's start tomorrow fresh and concentrated, and let's continue this discussion tomorrow. I will try from my side to keep it so crisp and so short as possible, just to come to the strategy sections, because I believe that we have a huge advantage in the strategies. But when we're talking about sweeps, then Raymond maybe understands anything else than I understand, and you will see maybe my other colleagues as well understand that stop runs or volume spikes. So just to make clear what we are talking about, have the same terminology what we are talking about, and then let's start with the strategies, because I strongly believe that what you will see during the next days, it's extremely helpful for your own trading. So thank you very much for the day, guys, and we meet tomorrow, same time, 9 a.m. Eastern time. That means in Europe, 3 p.m. European time, UTC +1. And please notice or make notices, send me emails, or put this in the room here for tomorrow to discuss, keep the discussion ongoing on that, what we are discussing here. Thank you very much, and have a great afternoon and have a great evening together. See you tomorrow. Bye-bye.
Thank you, Walter.
Thank you.
Thank
Bye-bye.
you, Walter.
Bye. Thank you.